Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing up to 90% and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show. All right, everybody. Good morning. Welcome back to another live stream. Hope you are doing well. Hope everybody's having a good week. It is Friday after all. I'm headed to my brother's graduation party after work today, which will be fun. So good times. Hope everybody's looking forward to the weekend. I know I am. So quiet on the Western front in terms of indices right now. We've just seen this very slow, gradual grind higher. However, not so quiet on the commodities front. We've seen gold continue its fall down. Silver also down here today. Copper's down 1.8%. So we are seeing some of the metals here take a bit of a pause yesterday and now seeing some rejection once more as we've come into this area of resistance. So we put in this key level here. This was a pause point here for us. Then we rounded out and broke higher for gold. We came back to this area, found support once more, came down to this area, tried to hold as support. And then when we failed, what I noticed is yesterday, right, we came right back into that region, that resistance level right here, which was support, right, now acting as potential resistance. So gold, however, there's a couple, we can get more technical on the lower time frames, but from a gold perspective right now, I definitely lean on the technicals front more towards bearishness. Now, I'm not looking for shorts. I'm not taking any short positions. I don't have a sell trade in on gold whatsoever. However, I am no longer long, and I've gone from actively looking to buy gold to actively looking to not trade it. So I just have nothing set up for me on gold. Specifically, though, what has kind of cracked the invincibility potion, if you will, for gold has been, keep an eye on these moving averages. For some time here, we have seen any reaction to the 20-day moving average, any retest of these areas, buyers are stepping in without fail, pushing this thing right on up. And we've seen the 20-day lose its ground, and we now see the 50-day moving average getting tested. And I would not be surprised if we break through this kind of 3,100 threshold, that we may actually have more downside to go on gold. We have to remember that, while I am not somebody who likes to try and call the top, and that's why I'm not actually willing to short, right? So I'm not actually willing to short. So let me transparently say, I am cautious on gold. I think price action is in the process of correcting, but that does not mean I chase shorts. It's the same reason why when the S&P 500 was dropping, I was telling you that over here I was cautious, right? I started buying stocks around here. Full transparency, I was way too early. However, during this initial sell-off, I was not bearish, but I was like, I am not invested in stocks. I'm like all the way out. And it was actually one of the better plays this year. I was very long gold at the time. But the reason I'm patting myself on the back about that is because as this thing fell, I wasn't short. So I wasn't benefiting from the drop. And then what happened is we did have the follow through drop. I wasn't short for any of this. But there is a point to say where, okay, I'm not necessarily short on a market, but you can also say, I'm just staying out. I'm choosing to stay out of this play. So when I look at gold, right, this is a beautiful long-term uptrend. But I do think we have had a really good run. And with the trade war stuff cooling off and, economic data not crumbling like people had thought it would, you're actually seeing, in my opinion, a window of time where we may see gold do something that we have wanted to see for a long time. You guys, if you listen to Chris Pulver, he's talked about this himself. We're both bullish metals. Like long term, I want metals exposure, gold, silver, all of the metals, basically copper. I'd like to have long exposure. But we are now finally in the process of seeing what I believe to be a healthy corrective move on this price of gold. Again, I was right there in the thick of it, trading the long side as this thing was ripping. But momentum, in my opinion, has shifted. And I do want to share with you guys, I put up another chart of the day. Today's price on gold is again making headlines for our chart of the day. Probably the most frequently charted of the day, if you will, on the Telegram channel. So just raising my mic a little bit. So anyways, if you're not on the Telegram channel, first of all, join. It's completely free to do. We'll drop the link here in the chat to where you can join the A1 Trading Forex and Futures Telegram channel. It is completely free to join. Please be aware there are fake channels and scam channels. We will never ask to invest your money for you or anything like that. I don't manage money. This is simply a channel where I share analysis. And if that is something that you are interested in joining, you can join completely for free. Let me actually drop the link here. Just give me a second. Where are we at? Hold on. Telegram, here it is. If you guys would like to join the Telegram channel, there it is. Click this link right there, and you can join completely for free. But I put out a chart on gold this morning, and you'll see that in the picture, what I spotted was, okay, we've got a double top here, right? Rejection off of the highs. But I don't look at double tops just like, oh, look, we held resistance. What kind of solidified that for me is that we broke the neckline, right? So from a technical analysis basis, this is our neckline. These were key levels of support. We broke down, we retested, and now, I believe that in the short run, the momentum here favors downside, in my personal opinion. Now, again, I'm not short, and I'm not looking for shorts. This thing isn't a long-term uptrend. I just think that we're in the process of correcting, and that longer term, I'd love to get some buys in. So that's my take on gold. Taking a look at indices, however, I think that they're a little bit stretched. I don't think that I am bullish, but I think they're a bit stretched. Looking for pullbacks on S&P, NASDAQ, Dow Jones. Wouldn't take much in this market here, guys. The market has now seen the VIX come way, way down. And so what I want to point out here with the VIX is that if you're somebody watching the VIX, right, let's acknowledge that we went from very extended VIX levels, suggesting that the market was freaking out more than what was appropriate, meaning volatility was very high. People expected the worst. People expected terrible, everything. Well, I will, be fair to this. Now I think we are actually closer to euphoria and overzealousness. I don't think that's a word. About the market on the other side. And we can also solidify this sentiment idea that I'm discussing by taking a look at the put to call ratio, which for the first time, ladies and gentlemen, has reached an overdone in the opposite direction reading, or an extreme greed reading on the edge finder. So what do I do with this? Because we went, like I said, yep, Alan's got it right. The market went from extreme fear to extreme greed. And when the extreme fear was in, guys, so I know that this is hindsight speaking, and I'm going to defend myself here, because you can go back and watch my content during this time. I was obnoxiously bullish about the markets because everybody else was so dang bearish. Now, the reason I'm touting this, the reason I'm patting myself on the back, is because that was the hardest time to be bullish, was when everybody was like, the trade war, Trump's going to ruin everything. And, people are terrified about what could happen. And I don't say that to be political, because people did the same thing under Biden. People said, oh, he's going to ruin everything with inflation. And my point is, people have a tendency to seek out and expect the worst. People get really scared and pessimistic very easily in markets. But to hold that opposite view as well we are now, in my opinion, getting a little too frothy. People are getting a little too excited. People believe now everything is all good, that no trade wars, no trade issues, no nothing. It's all sunshine and rainbows from here. So let me tell you that, in my opinion, the quote unquote easy money was here. Now, I don't mean easy money in the sense of it was easy to sit through a painful market sell off. It was not. But I think from a purely logical, purely statistical examples in the past of when market fear gets that high, your forward-looking returns in the market are typically positive. They're typically better than average, actually. You get a put to call reading like this, most of the time the market pays you to step in and take a big, scary bet to the long side. And that's what I did. So now, however, I use the put to call ratio all the time. It's my favorite sentiment indicator in the book. That's why I always pull it up on the streams. I think we're getting close to some opposite extremes that make me a little bit cautious. So when I look at the NASDAQ, look, I am bullish. There are many reasons, in my opinion, I have been bullish. I still am bullish. So don't get me wrong. I am not saying, oh, I think, we want to be shorting this market. It's absolutely, I'm not short biased. I am long biased, but waiting patiently for the market to come back to me. And I think it will. This is my opinion. I think that we're due to see a little bit of a pullback in this market. Maybe it's the next few days, maybe it's the next few weeks, but I don't think it's just going to be sunshine and rainbows from here. And I think that we may see a pullback. Again, I'm not saying I think we're going to have a giant retest of the lows. I don't think that. I just think that there's a good chance that we do see, a couple percent down, maybe a 5%, 6% pullback into this area of support. And if we don't get it, oh well. But I do like the idea. I love this setup quite a bit. So like where I think there is easy money again, quote unquote, and I'm going to use a different, where I think the simple setup doesn't necessarily mean it's going to work, but the setup that I like is this scenario. Let me use a smaller size. Basically, we cap out, some of that negative sentiment creeps back in, and I think that the opportunities there look really attractive. But the risk to reward, in my opinion, on NASDAQ and S&P and Dow Jones was great over here, and it's way less attractive here. I don't see nearly the risk to reward. And this is what I want you all to be thinking about when you're considering setups, right? You need to consider, what's the risk to reward look here? Because I'll tell you, if I was to put a stop loss on this, let me tell you, here's why the risk to reward. Let me give you a visual as to why I think the risk to reward here is not so great. If we're talking about NASDAQ and I wanted to put a healthy stop loss on this trade, the clear level that I see, the clear and obvious level of support is around 20,200 on NAS 100, this CFD that I'm looking at. So my stop loss really would have to go here. And I'm not targeting all-time highs. I think we could break out this year. But do you see what I'm getting at here? The risk to reward is not very good. For me personally, in my trading style, you may have a different style. You may trade the 1 hour, you may trade the 15-minute chart. But from my perspective, many of you guys know very well how I trade. My trading strategy is not a secret. If you watch the stream every day, you'll pick up on it pretty quick. But my opinion on this is that the risk to reward does not look very attractive to me at these levels. Now, again, I have a whole bunch of stocks. I'm long Tesla, Nvidia, Amazon. I bought the Mag 7 heavy, and it's been going quite well. Tesla, let's see what today's up 1%. Meta down a little bit here today. So I have a lot of stocks that have done phenomenally well in the bounce back. But do you see what I'm saying with this? This is where I'm saying, okay, the risk to reward to be buying at these levels does not meet my standards for like what I would take a trade on. And you might say, well, Nick, the market doesn't care about your standards. And you're right, it doesn't. I'm waiting for it. If it never comes back, if we do this, if we just go like this, then guess what? I missed a momentum setup on the NASDAQ or the Dow Jones. And if that happens, it happens. It's going to happen sometimes. So what am I going to do about this? Here's what I'm going to actually do. I'm going to wait. And if it comes to me, do you see the difference? Do you see the difference in risk to reward here? I didn't have to move my stop loss. If I were to buy right now, that's where my stop loss logically would go. That's really far away. That's a 9% drop. I don't really necessarily want to risk a 9% move because I'd have to have a tiny position size to justify it. So instead, to account for such a large stop. So instead, if I get this move and there's a 3% move, a 3.3% move on the NASDAQ, I trade the QQQ ETF, 3% on the money that I put in is valid. Not necessarily 3% of my account, but 3% of the cash invested. So if I buy, just as an example for simple math, if I were buying $100,000 worth of QQQ, I'd be risking about $3.3 thousand. Does that risk make sense? To me, it would make more sense than 9,500 or whatever it was, right? That doesn't quite make sense. I hope that breakdown made sense. This is why it is very important at the end of the day to wait for setups, because it's the painful thing to do, but it's important to do. Like we've had a wonderful win streak here, and congrats to everybody who was long. If you own some stocks, if you went shopping during this market sell-off, we've done very well with pretty much everything you could have bought, barring like United Healthcare, which, by the way, what's that guy doing? It's up 2-3% in the pre-market, but pretty much everything, like most stocks, have done remarkably well bouncing back. And so what have I actually done in my trading per se for this? Well, I've actually sold some calls, and I don't want to get into the option side too much because it's not very popular on my YouTube channel. I know not everybody's super interested. So basically, I have sold some calls against many of the stocks that I've owned, or that I do own. I sold Tesla calls. I sold Robinhood calls. These stocks have done phenomenally well for me. And because I think that the market is a little stretched and due for a pullback, I'm not necessarily shorting or selling all my positions, but I'll sell some calls against my trades because I think that there's limited upside from here personally in the short run. I could be dead wrong, and I hope I am, because I would make more money. But I think that there's a pullback that could potentially be coming next. And if it happens, great. I can get some new buys in there. So something to think about there. Let's see. But yeah, put to call ratio reaching kind of an extreme level here to the opposite end. People are, I think, a little bit more confident. We also see that in the investor sentiment survey that came out. 44% people now feeling bearish, up to about 36% of people saying they're feeling bullish. That is a big jump from the 21% of people saying they felt bullish a couple weeks back, right? So sentiment has not necessarily greatly changed, but it's changing. It is shifting bullish, or in the process, I believe. If we keep going up, the sentiment in this market will continue to get more bullish. The gold market here is also sort of interesting. We do actually see, and this is one of the more contrarian bullish signals that I'm seeing here. Gold, we saw a lot of, actually we see it kind of normalizing now, but there was some incredible pessimism on gold that corrected yesterday because, of course, gold was up. So people who were, buying a whole bunch of puts on gold in the last few days covered some of those, it seems. So anyways, when we look at the gold put to call ratio, it's kind of back to neutral. Let's take a look at some other ones here. NASDAQ's also still very, very scared, which I find really interesting. We still have a very high put to call ratio on the NASDAQ, which is interesting considering you still have, right? So there's still your bearish sentiment. S&P is way more normalized or even bullish. People are feeling bullish on S&P. Interestingly, NASDAQ is still kind of super high put to call ratio. So something to think about there. Just DAX, what the heck is this? That's a crazy chart. Dow Jones, kind of getting closer to that kind of high demand for calls as well. Let's take a look at Dow Jones really quick. Dow Jones holding steady just above this 42,000 level. We've got to actually mark these as support zones now. Again, very impressive breakout here. The Dow Jones is still quite a ways away from its all-time high, and you may be wondering, why is that? Why 6.4%, still a good ways from its highs. Meanwhile, S&P 500 is at this moment only about 3.7%. Why is the S&P closer? Well, again, the big one is if we take a look at healthcare stuff, like XLV tracks a collection of, it's an ETF that tracks a whole bunch of healthcare stuff. Well, dragged lower by, of course, United Health Group, which had a dramatic drop. I mean, this is a horrifying drop of 53.5% for the stock in just a month. I mean, absolutely insane. Let's take a look at oil prices here. Oil prices on the daily chart, kind of something interesting to me. We do see resistance, at least for now, holding up on this market. We see, sellers around the 64 level kind of holding. I'd be really curious to see if we can actually get a breakout if we are not going into global recession, if we're going to see trade relations smoothing out from here. Oil would likely be a winner in that, right? Because the demand for oil gets threatened by recession and slowdown of trade. But if there's more trade and communications are going well and economies are doing okay, the demand for oil should remain elevated. So I do actually think that there could be a trade shaping up on oil. I've been circling this one. I've been watching this one for a minute here. It was getting a bullish reading on the Edge Finder. It still is. Yep, we're getting a +7 on the Edge Finder. Some economic data has come in relatively upbeat here recently compared to forecasts. We had good retail sales. Well, it was better than expected, but still not amazing retail sales this week. Out of the United States, we had PMI numbers that came in better than expected. The employment data came in okay, right, with the NFP report. Trend has been shifting to the upward direction, but I'd like to see that resistance level break. You've got seasonality that looks okay and retail positioning. Let's just take a quick look at the put to call ratio for oil while we're discussing this, because oil is pretty top of mind for me in terms of setups. Take a look at oil. We do have still quite a bearish sentiment out there. Look at how crazy this went. Late April, people got super bearish on oil, and now people are kind of flipping back towards once more people feeling very bearish. When you get this reading very high, that's telling you that the put demand is quite high in the market. So I actually like that as a potential breakout signal. If you got everybody kind of buying puts bearish on the market for oil, and you do get that breakout, sentiment has been real bad for oil for a minute now. So I do think that there could be some breakout opportunities to watch for. You also kind of have this longer term breakout level that I think is really interesting. So if you get kind of the double whammy here where you get like a big push, retest, that setup looks, in my opinion, excellent at this time. I really like oil for a breakout and retest trade, but I don't currently love it at these levels, right? So I'm bullish, but waiting for technicals to kind of kick off and get going to the upside. So that's what I'm watching for on oil at this moment. We can take a look here. What else do we have on the list? The DAX sitting confidently above all-time highs, looking really interesting there. Chinese stocks still working their way back towards those highs. VIX down 2.3%. People still cooling off. I think that, again, based on my sentiment on the S&P 500 seems very, very positive now. People very constructive. I actually think that you may be getting, I think that, so we are now below the 200-day moving average for the VIX. Okay. The reason I mention that is that the old expression for options traders is that when the VIX is way above its long-term moving averages, you really want to be, well, you do whatever you want. But for me, what I'd like to be more focused on is focusing on a mean reversion back towards that 200-day moving average for the volatility index. Where we now see price going is we have not only retested that 200-day, but we're now trading below the last 200 days average volatility in terms of the volatility index. So what you'll see here is that for the most part, this thing kind of snaps back to the 200-day. Even when it goes crazy to the upside, it does make its way back to the 200-day moving average. So in my opinion, what that does is it skews risk to reward pretty heavily. What I mean by that is that when it's over here, bulls in the market have the advantage in terms of risk to reward on a historical, purely statistical basis. Typically, this is a decent time when the VIX is up, up over 50. That's a pretty strong time where indices and individual equities have good forward-looking average returns. When you get really low on the volatility index, you just, in my opinion, want to be more careful because we could very quickly snap back in to a volatility environment. I mean, whether you like or dislike the current administration, they are a volatile group and they cause, some people love what they're doing, some people hate what they're doing, but it doesn't matter. The market itself doesn't like uncertainty. And when that uncertainty does kind of come in the form of an aggressive tweet or something said to another political leader or some development or decision, some change, the market can freak out at any moment. So again, I think the risk reward was great over here. I think it's a lot less attractive at these current levels in terms of risk assets and going long heavy. Same thing with Bitcoin. You take a look at Bitcoin here. I think that the risk to reward here for Bitcoin is, you're back towards those all-time highs. And as you near them, could we make a run for new all-time highs? Very, very possibly could. I just think that the risk to reward on something like Bitcoin, again, becomes more attractive if you get the pullback and you wait carefully for that. For me personally, Bitcoin, the risk to reward, way more attractive here than where it currently is at these levels. Again, waiting for pullbacks, trying to be disciplined because it is hard when everything's running in one direction to not chase that move. But again, this market can turn on a dime. It can be very aggressive in the upwards direction and in the downwards direction. Anybody who was watching this week of time, this April sell-off, knows very well that the market can be relentless to the upside and to the downside. So we have seen an upside move. And I do think that there is likely, in my personal opinion, as I've been discussing, room for some corrective pullbacks down to, 5650, 5800, somewhere in this range. I think is a very normal pullback that I'm not necessarily betting on happening, but would love to see. Back to gold here. We discussed it earlier. Let's take a little quick update on this one. So gold, in terms of I want to look at the daily chart here. Long term, it looks like we have cracked some of the momentum that we've had. I am not necessarily bearish on gold, as I discussed earlier, for those who were here. Not necessarily bearish, right? But do think that we have room to expand deeper into this pullback. Now, again, why do I say I'm not necessarily bearish? Because there's a difference between saying I think we can continue to pull back and I'm shorting this market. That's two different things, right? Longer term, I'm a bull. Longer term, I think actually, if you get these moves, these, in my opinion, are opportunities to buy long-term gold positions. For me personally, you do what you want. This is not financial advice. But what I'd be looking for is a pullback further before really the price looks attractive enough for me to buy. It's kind of like, when Warren Buffett, sometimes people will say that because he's not buying stocks or that he's holding cash, that he's bearish on the market, which is not true. He's actually declined that way of thinking many times in his career. When he's holding cash, which he gets questioned about all the time, people think, oh, Warren Buffett is bearish on the market. And while holding cash is a proxy way to be cautious or bearish on the market to an extent, arguably, it also is a way to just say, the current prices are just not attractive enough for me, risk to reward wise, and I'm just going to wait. And maybe you don't get better prices. Maybe the market gets more expensive. So there's a difference between saying I'm betting this market is going down and saying I'd only be interested in buys if this market goes down. Do you see the difference? There is a very, very clear difference. So be very careful with that way of thinking, because a lot of people are like, oh, they hear Warren Buffett's in cash, I'm going to short, stocks because he doesn't like them. And just because he's not ready to buy, that the prices aren't at levels, does not mean he thinks the market is going to crash per se, right? So with gold, like I said, I think that the easy trade, the easy momentum has passed us. I don't see that right now. Maybe it returns, but I think you'd really need to maybe we're just in a range. Maybe we're in this process here, right? But I think you need a catalyst. I mean, these were high prices, 34.50. It's a really, really, great movement. You got to think this market move since 2020, which is, I think, where you really got the kickoff of all of this crazy story. The 2020 sell-off from the lows, gold had at one point gained 140% of value. It's an incredible move, right? So it's probably normal to say we could have another 2020 to 2021 corrective pullback, which was, a range that we stayed in that bottomed out around 21% down. So we may see it's kind of a frustrating thing to think about if you are somebody who's been really loving the gold trading the last few years. It could be frustrating to think about the idea of like saying, if we saw a 20% range, this is a frustrating thing to think about. What if you see this type of environment over the course of the next year and a half, 2 years? Is that frustrating? Yes, because price moving sideways over long periods of time does happen. Just ask a currency trader. That is currencies 101, right? Currencies 101 is over the super long term. They typically go sideways. Most of them. Over the incredible long term, like decades, they might have a tendency to trend a particular direction. But over like years of time, they typically just go back and forth and back and forth. Like take a look at the euro, which had a beautiful downward trend move, massive decline, euro against the US dollar, only to basically retrace of this move, hit the 61.8% retracement, and basically just trade sideways. Before that, we went up all the way over here. We gained, we dropped huge, we gained, we dropped huge, we gained, we dropped huge. So just something to think about is, the different markets have different styles, and gold can enter into a phase where we don't go in a direction, which is frustrating to trade on a long-term basis. I can tell you that right now. If stocks enter into the same kind of concept, that is also a frustrating environment, because and typically an environment where I struggle a little bit more with my main trading style. Now my side trading style, the my option selling strategy thrives in sideways markets. It's why I use it, right? I have two strategies. I have a dollar cost averaging approach and a momentum strategy. Now, the momentum strategy is way more popular on my YouTube channel. It's what I talk about all the time when I'm talking about like technicals and fundamentals and sentiment, and I'm looking at trail stops. That's the style of trading that really, I think more traders understand and gravitate towards. Dollar cost averaging I do in FX, and I do in equities options. Very similar to Chris Pulver, if you're familiar. Chris Pulver and I have very similar ways of trading Forex, and he's way more complicated. Well, complicated is the wrong word. He's way more advanced with his options trading than I do. I trade very simple options trading strategies that essentially capitalize on markets that are moving sideways, or essentially I don't want to get too far into it because it is very not super attractive to most of my audience to talk about options. But like, let's just say with Tesla, I hold shares. I can actually make it so that if the market goes sideways, I make money. How do I do that? Well, I sell calls or I sell puts above or below current price. I essentially sell bets to other traders. You know how you can go buy a call, right? Well, somebody else out there sold you that call. You can be an options seller. Now, when you sell options to traders who are betting that a market is going up or going down, it is not easy per se, but it's a relatively straightforward concept. You are playing the casino. When you go to the casino and you make a big sports bet, right? The casino is facilitating your bet. They're saying, okay, you want to bet on, XYZ team or player or boxer or whatever to win the fight. They will sell you that bet plus some premium, right? The spread or whatever, right? So when casinos sell you bets, their money is made on the bets, right? They don't actually make money fading you necessarily, because what they might do is, let's say you have two fighters, and here's the casino, right? The casino is selling bets to everyone. You want to bet on player one or fighter one? A lot of people rush to buy this. And then, oh, you want to bet on player or fighter two? Okay, a bunch of people fight over this. The casino's goal is actually to break even on the actual bet volume that they have to pay out. Because let's say that the winner is fighter one. Well, what does the casino have to do? they have to pay everybody out, right? How do they pay out? They collect all the bets from the losing side and they pay out the winning side. So where does the casino make money? The casino makes money by selling. Whenever you take these bets, they collect a little bit extra. They collect a premium with every single bet from every single bettor. Okay? Now, this model is very profitable for casinos, as you can probably imagine. They're not really making a decision on who they think is going to win the fight. The players are. The casino is not making money that way. The casino is making money by selling you the bets. Does this make sense? If you're following so far with this concept, type yes. It's a core thing that I do in my trading, and I'm excited to tell you about it. I'll give you the high level view. Blint says, frankly, I started with options spread trading, and it really offers endless opportunities. As you learn strategies and combos, your horizons expand. You start to see the markets like Neo. Blint, I like that message. I'd highly recommend that if you are interested in this subject, you stick around for Chris Pulver's segments. He is, this is notoriously what he does. So what are we doing here? Well, I'm gonna dash some dreams and hopes really quick. Option selling is not a quick way to make a ton of money. In fact, it has its own list of challenges. It is way more oriented towards slow and steady, small percentage gains over time kind of approach. Otherwise, you can blow up very easily because you can over leverage as the quote unquote casino very easily. If you administer too many bets and one side is unevenly weighted and you blow up because you have to pay out, right? Casinos can blow up. So here's the thing. You can replicate this kind of concept through the options market by selling options. Now, when you sell an option, let's say we're talking about Tesla. Tesla is a very volatile stock. If I sell calls at 40, right, I'm selling someone else a bet. Somebody else wants to bet that Tesla is going to go up to 400. I'm selling them that bet, which means if they're right, I have to pay them out. Well, what if I want to sell puts? I can also sell puts. I can sell bearish bets. So somebody else thinks Tesla's going to crash. Well, what you can do is the casino player, quote unquote, or the casino owner is in the options market. You can sell puts. So other people want to buy these puts. Other people want to buy these calls. They think Tesla's going to rip. They think Tesla's going to crash. Okay. You as the seller of these options say, well, I don't necessarily think it's going to fall that far, or I don't think it's going to rise that far. And as long as price is below or above by the end of the bet duration, which we call the expiration date in options, you make money. You kept your premium that everyone paid you to place those bets. Now, I have a whole video and a whole topic on this, and we talk about it in the VIP group. If you'd like to look this up, search up Trader Nick Options on YouTube, and you can find out some of my trading strategies that revolve around options. Now, here's a warning. It takes a lot of capital, and people hate that, but it is the reality of option selling. However, there are some ways that small trading accounts can do this with an options brokerage by doing what is called debit spread or credit spreads, where you sell a put, or let's say you sell a call and you buy back another call to limit your upside risk. And the other thing that is warning with selling calls and puts is that you can get yourself in a lot of trouble. If you sell a big bet, let's say I sold Tesla calls, right? And the market rips like massive. Well, I promised to cover your bet. And so I'm on the hook for that huge win that you just had. So there is no secret sauce, easy way to make money in the markets, at least that I'm aware of. If you find it, let me know. But option selling, in my opinion, there's some great ways to use it to your advantage. With options, you need a minimum of $30,000 to start with. If you have more, you deposit more. So yes and no. You don't necessarily need that much to start selling options, because what you can do is you can do what is called credit spreads. So you can search those up if you want to do bear put spreads. bull put spreads or bear call spreads. It's all sorts of things. Anyways, gold here down 1.8% this morning. I thought it was interesting how price came right up and retested this area, then sold off. Also, guys, I mentioned this earlier, but if you haven't already, take 2 seconds really quick. Make sure you've joined our Telegram channel. It is completely free to join. And in the Telegram channel, we are sharing all sorts of stuff each and every day. Bonus clips from the content. So in case you don't have all day to watch the stream, we're picking out some of the best moments and sharing them completely for free. We also do polls. You can see I voted on this poll. We said, what do you struggle with most? Entries, exits, or not crying? You can see my selection was not crying. So if you're not already in the Telegram channel and would like to be, click the link that's just been dropped. It is completely free to join. And also, special announcement. Tomorrow is Chandler's birthday. Big shout out, Chandler. Happy birthday to you, man. And that is awesome. Absolutely awesome. May 18th. Sorry, Sunday, right? It's May 18th, Sunday? Yes, Sunday. There you go. Happy birthday to Chandler. Big thanks to him and James for putting on the show each day and making this show look easy. It is not an easy thing to, we bring on talent, we recruit talent, we vet talent, and try and put together a free show to try and help the trading community as much as we can. If you'd like to support us, the easiest way to do that is to hit the thumbs up button and subscribe and wish Chandler a happy birthday in the chat. Dollar index hitting 100.77 here today. Pretty interesting to watch this one, break back above this level of resistance. But I'm curious to see if this is truly, the start to a bottoming formation that the dollar index is on. We've seen some good economic data. However, I think we really need to see some higher lows and higher highs to solidly say like dollar index has truly bottomed. But right now, I think that the risk is to the upside. And what I mean by that expression is that the risk to the upside means like the bigger move potential, in my opinion, would be to the upside than to the downside. It's my opinion. We'll see. But we've had some good economic data here recently. We've seen trade deals starting to come in. And I think that could potentially continue. We could see that expand further. I believe that in terms of top setups, we have on major currency pairs, only one. Dollar yen is the only convicted bias on the edge finder for dollar crosses. I did get long dollar yen. Let's see how that one's going here today. Not particularly well, if I remember. Dollar yen. So I'm in the red on this one. I'm also in the red on NZD JPY. I went long here and then bought dollar yen yesterday. So my entry timing, not particularly great. But I do like the upside for yen pairs still, and we'll probably stick to the trade until proven otherwise, until there's a reason to really step out of the way on these ones. But yeah, in terms of dollar crosses, I think dollar yen may be in the process of bottoming out. And if the dollar does have a rally, I think that dollar yen would be potentially outperforming the others. It's my opinion. We'll see. We do have some sentiment numbers coming out, I believe, in 15 minutes or so. In just a second, we're going to have the show taken over by Forex James. I got to run to the restroom here. We'll pass over the show to Forex James. If you haven't already subscribed to Forex James, what are you doing? Takes 2 seconds to do. We'll drop the link to his channel. You guys know him. He's a regular contributor to the A1 Trading Show and he sees the vision. We're all on the same page here with just offering some genuine, helpful stuff to the trading community. I think everybody who comes on the show has, to some extent, to some degree, a love for the trading community, all of its goods and bads. There's plenty of both, but we try and just keep it real on this show. And with that said, up next, we have got Forex James. Remember, join the Telegram channel. We'll be sharing more free updates. Link is in the chat and in the description if you are not already in there to stay up to date with the show, even when you're not watching. Okay, stay tuned right after this.
Attention A1 Trading Show fans. If you're interested in getting free access to the Edge Finder or our premium trade alerts, listen up. For a limited time, our show's partnered broker 8cap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to 8cap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now, back to the A1 Trading Show.
Happy Friday. Actually, let me just share screen quickly. How is everyone doing? Hope you've had a great week. So I saw some, here. Why didn't the Bank of Japan want to raise rates? Why go long? Jen pairs. Yes, you are half right. So the Bank of Japan exited the NIRP, negative interest rate policy, and they are on a long-term path back to normalization. However, it's not that simple. They can't just hike all the way back to normalization, 2 to 3% IR. So from the last Bank of Japan meeting, this is the notes I've got. BOJ holds rates at 0.5 amid US tariff concerns, lowers GDP and inflation forecasts, suggests delayed and slower pace of future hikes. So yes, you would, in theory, long-term, long yen. Short-term, as Nick said, if we are going to get a dollar rally, the yen is probably the best asset. And I would also suggest the Swiss as well, as we are getting that liquidity flow from risk-off assets into the risk-on assets. Wow, a lot of people saying hello. How's everyone? It's good to see you all here. A lot of familiar names. James, what do you think about negative GDP reading of Japan? It does, Royal, exactly. Kind of essentially what I just said. Yeah, if we have a look at the current, actually, let me just double check what the inflation reading is in Japan, but I'm fairly sure that's also not ideal. Or is it? Yes, so CPI has come down. So inflation came down from 4 down to 3.7. It's now down to 3.6. So if we are having disinflation or lower or cooler inflation in Japan, that is, not beneficial for that rate hike narrative. So it's kind of a case of just waiting, I don't see any short-term opportunities to go long on the yen at this time. I think it's more a case of very, very likely we'll see continued downside until the Bank of Japan start hiking rates again. Because the problem is the Bank of Japan is known for being slow. They're not fast movers. So if they are holding rates, the markets are probably going to expect them to continue to hold rates until we've got a very solid sign that that's not going to be the case, whether it be inflation increasing, whether it be the final result of tariffs. I don't know. So yeah, we'll see. Alan, hello. My top setups, I don't really have any. I mean, you say top setups for the week, it's Friday, my week's over. I was looking at the US dollar yen. I've been watching all of these all week, but I'm not taking any trades. I'm away next week on a bachelor party. So I think placing trades this week that I would then have to manage when I'm drunk with, strippers and models, probably not the best idea. So yeah, so just more a case of watching the markets rather than actually placing anything. But what's encouraging is everything I marked up has worked out so far. So I was bearish on gold, or my overall idea was bearish on gold. I didn't want to even really pay much attention until we did fill this gap. But it seems like maybe not going to happen anytime soon. Euro dollar, I'm bearish. I am pretty much always bearish on euro dollar unless there is something like we had with the, the German fiscal stimulus. That was a special situation. Or if we've got a big central bank divergence between the ECB and the Fed. But generally speaking, euro dollar to me is always bearish. Oils would have been doing quite well. Euro pound, still really like euro pound to the downside. So if we can maintain this sort of level where we roughly are about now, by next week, I will probably start to build a DCA position short euro pound, looking for that reversion. Pound dollar hasn't moved really all week. It's just been stuck sideways. New Zealand US dollar also still looks fine. I was looking for an entry at this 50% retracement, which would have been great, but again, not for me this week. And yeah, brings us back to dollar yen. So that's it. Will there be any live for the OUM announcement? OUM announcement? I'm not sure. What are you guys saying crazy for? Whoa, crazy? What's crazy? Okay, let me pull up the Edge Finder. I'm a bit behind today. Yeah, let's have a look. See what the Edge Finder is telling us to do. It was the Dow that was giving us the best reading, or the most bullish reading. I'm not sure if that's still the case. It is. So we've got Dow, very bullish, score of 13, which is still great. We've got a very typical risk-on reading at the moment. So we've got the US markets, well, indices, generally speaking, US, Europe, Russell. I'm not sure about the Russell, just because of what the Fed spoke about, and obviously we've had a rate hold. So in my view, the Russell's probably not the best option right now. We've obviously got short yen, pound in New Zealand, risk assets long. So yeah, it's pretty sensible right now. Oil is also getting a nice bullish reading. Oil is still very cheap in my view, obviously relative to the average price over the past couple of months. I think oil is quite a nice buy at a relatively cheap price. So again, if we can maintain sort of the current price on oil, I might look to go long next week when I get back from the bachelor party. James will be live for the bachelor party. Probably not. No. That will be, what stays there. Oh, sorry, what happens there stays there. No videotaping, no pictures. Manu, I'm going to be honest, I have no idea what any of that says. Clyde, can you still enter what? And I'll be honest, if you're asking that question anyway, regardless of the asset, no. You shouldn't be coming on streams asking if you can enter or if you should buy or sell. No. This isn't like it's not a game where you can just get someone to tell you what to do and it'll work out for you. You need to be able to decipher these things for yourself. Can you check yen pairs? Yes, we can have a look at some yen pairs. Again, nothing overly interesting right now for me. However, I really like where dollar yen is. I think if you are going to be a buyer of this market, this is one of the best entry points I can find because this hasn't broken this uptrend. I mean, we've very clearly got this higher low here, filled in the gap. We've reached previous structure. This is also the 0.5 level on the fib. It's perfect, technically speaking, and fundamentally, I am bullish on the dollar, as I've been saying all week. New Zealand yen, also, if you're feeling a little bit not risk averse, I think New Zealand yen could be a good play as well. New Zealand dollar is a heavy risk on asset. So during times when investors are fearful, New Zealand dollar will be hit quite hard from obviously that capital outflow. So we're seeing that flip and we're seeing investors come back to risk on. New Zealand dollar is quite a nice buy in my view. And again, as we've already said, I think the yen could also be a pretty good short for the short term. James, which character would you be from the Hangover? I reckon I'd be the monkey. Other videos where you show how you manage trades. You know what, Flo? I'm actually working on a video today, basically breaking down the dollar cost average management because the entries are quite simple, but the management is very, I'm not going to say difficult because it's not, but it's complicated to try and explain. But it obviously can be done. But yeah, I'm currently working on how to do that properly because my swing strategy is so simple. I can explain it here where basically take a position, we'd wait for either the break, we'd wait for this retest to happen, we'd take a short, pretty much like FX LXG, like that, but with information behind the trade. Or we'd use a fib. If the fib lines up with that as well, it's a lot stronger. Very simple. Trade management, I don't really have one. So let's take this trade, for example. If we now drop into 1% profit, depending on the individual trade, I will likely move stop loss to break even and let it run. Or if, it really depends. But the management for swing trading is very, very simple. However, for dollar cost averaging, it becomes a lot more of a hands-on job, not because you're moving stops and things, but because you've got to be able to actually, you know, if you're interested in me explaining sort of the dollar cost average and stuff, I will do it, but I don't want to. I've only got another sort of 15, 20 minutes here, so I don't want to sit and explain it for the next 20 minutes if no one actually cares about it. I feel like James gets out of hand after a few drinks. I don't know. To be honest with you, I'm not really been drunk for a couple of years. I think the last time I was drunk was in my late teens. 26 now, so I don't know. Hopefully I'm over that phase of life, but you never know. James is away, your long cigars. Yeah, I need to pick up some actually. I'll get some from duty free. Yes, Alex is the guy with pink Bugatti. This is the thing actually, and I think he's a great example of, in theory, anything can work, because his technical approach, I think, is actually pretty solid. I don't really have any problem with that. But the problem I do have is that he has no context. So when we had, I can't remember when it was. It wasn't that long ago. We had something happen with the yen. I don't know if it was an intervention or if it was news. I can't remember. But he got caught in that, and he put an Instagram story up saying, I don't know what just happened. Trade just hit stop loss straight away. These markets are so hard, or something like that. And, you know, it was very clear what actually happened to the markets, but he had no context. He had no idea what was going on. But his technicals are very similar to what I do. So it's like that. Again, in theory, anything can work, but if you have context, you can sort of filter out those poor quality trades. Because break and retest and all that stuff happens on every time frame, all the time. So if you've got no idea where to focus, you're going to end up taking all of them, and you're going to lose. James, talk about how you disagree with my gold long, and now it's looking good. I wouldn't say it's looking good, to be honest with you, Paul. Out. To me, this looks like it's going to continue lower. Yeah, I don't know. I'm still not on that page, Paul. I'll be honest with you. Flow, I don't do partial profits. No, I like to have a trade. I like to, when I set the take profit, I say, okay, this take profit is 3%. And maybe I've just had 2 losing trades. And it's like, okay, well, that will clear out the losing trades and leave me 1% profit. That's what I want. I'm not placing a trade saying, oh, I'm going to scale 25% here. I'll scale another 10% there. And then I'll get out at this. Like, why would I do that? The only thing that does is limit my upside. And yes, it kind of reduces downside. But if you're managing risk properly, that shouldn't really be a big deal. And if you're confident in the strategy, again, that shouldn't really be a huge factor. That's just my view. I know there are people, obviously, that are successful at do partials, but it's not for me. Red fold in using 3 minutes. Okay, let me have a look. Yeah, okay. Let me leave that there. Naveen, good to see you too. You do want DCA? Okay. Loris, I don't think you can really steal a technical approach. I think it's all public anyway. It's all, you know, it floats around. I don't really believe in that thing of, oh, he stole a strategy. I think you could only really say someone stole a strategy if they say they created it or they discovered it or something. But just using it and using it as like a branding thing, I don't really see that as a problem. My timing for trades has been horrible lately. Do you have any tips for that? What's currency strength? Okay, so we got consumer sentiment coming in at 50.8. That's not great for the dollar. Let me actually pull up the dollar. Give me a second. I'm a bit poorly prepared for this. Let's put it onto the 5 minutes. Yeah, so initial downside off the dollar. We've got inflation expectations coming out at 7.3, up from the previous 6.5. Yeah, dollar's not too happy about the consumer sentiment. Okay, let me just move that so we leave the dollar there for a second. Let me just see what else is going on here. Yeah, I'm not going to speak about Alex or anything. I'm not in a mood today to start roasting people. Trend lines and moving averages for indicators and order block and FVG plus fundamentals. Okay, if it works for you, it works for you. Not for me, but everyone trades differently. I think Uzziah, I'm sorry if I butchered your name. Trend lines are tricky because they're so discretional, and it's very difficult to say everyone's looking at the same point. So if we look at the dollar's actually up on that. Here, this is a great example. So I've drawn both, but I'm not going to trade off these trend lines. It's more just for a visual representation for me and for whoever's watching the video or stream. But you've got one touch here, you've got another touch here, but then this trend line just scales off and has got nothing to do with this low. Whereas if I redraw it here, it's got this low and this low, but it doesn't have these previous ones down here. Do you see what I mean? So it's completely up to the person drawing it on how exactly it's drawn and where it is. Whereas something like a moving average, unless obviously you can use different periods, but that's still a set piece of data. It's not going to change really, or it doesn't change. Fibs, they're slightly, do you draw it from the wick or do you draw it from the body? But other than that, again, it doesn't really change that much. I suppose you could say where's the high and low, but again, that I would say that's pretty obvious. But yeah, trend lines to me are the most discretional thing, which makes it the most hard thing to trade. But those Tory trades. As far as I know, she makes more money than I do off trend lines. So who am I to talk? Yeah, OT order blocks are basically just support and resistance. Just from the previous low, previous high, as far as I know. Okay, so I'll tell you what we'll do. For the next 10 minutes, I'm going to give you an explanation of dollar cost average, because I think recently it seems to be getting spoken about a lot more. I know Nick's talking about it. I talk about it. I know that Chris Pulver, I think dollar cost average as well. But I don't really see any information on YouTube about how to actually do it on currency pairs. You see a lot about investing, but not in sort of active trading. So I've got positions all throughout here. I'm going to use the current one, this current market, to explain how I managed my recent positions. So I sold euro dollar here. I took profits here, but we were stuck in an overall range. So I was like, you know what, we failed really to break any higher. This low came down lower. So I shorted again at this point, and I just said, okay, just based on the recent market, price is likely to come lower, but I'm fully aware we've got this candle here that could be corrected. But I'm not really paying attention to technicals. This isn't a case of drawing fibs and supports and resistance and stuff. This is a case of just getting into the market and building an average price at least the way I trade it. So I sold. All right, so let me just restart that. So I sold here. This was the most recent sort of losing position on this. Market came up against me. I sold again here. Market came against me. I sold again here. Then the market came down to this point. So I was like, okay, this position is now down, or at this point, this position was down too much. So I'm going to cut this. That trade's done. Now I sold again here. So my average price comes up. And I know this is a little bit of a rudimentary way of explaining it, but again, I'm doing a YouTube video on it in a lot of detail. So for example's sake, my average price is now here. And a big problem, or a big mistake that a lot of traders make, is they'll have their average price, and an average price is essentially the break-even level, which actually would be more around here, I would say. So what this means is this position will be losing, this one would be winning, and this one will be winning. So these two winners would wipe out this loss, and the whole position would be equal to zero. So that's what your average price is. But people don't account for this trade down here. So they'll have an average price here. They might close out the whole position here, think they made money or think they got out break even, but they didn't, because they just lost on this one. So they've actually just lost money on DCA. So you need to be able to calculate the average price according to also the losers. But the higher the market goes, the more you cut these, the more you add in at higher prices, your average price comes up, and it becomes very, very easy to manage these losing positions, because essentially your drawdown wouldn't wouldn't exceed a certain thing. So let's say my account balance, for example's sake, is $10,000. Max drawdown I want, the absolute worst case is $1,000. So that's 10%. So I'm going to allocate 2% of the account to that trade. So the whole position would never exceed $200 drawdown. And if it does, then I'm cutting the biggest position and then re-adding in to get that average price higher. So that's sort of the fundamentals behind it. But again, I know that was quite a rudimentary one, but yeah. And the reason for euro dollar is because it's such a simple market to DCA. I mean, yeah, you'll have these large moves, but I only ever sell euro dollar. It's basically short only portfolio. I never buy euro dollar. Oh, sorry, I never DCA long euro dollar. I'll buy it obviously for swing trades, but not for DCA. I'm always short. And one of the things behind that is if you look at some of the largest moves in euro dollar history, a lot of them are in favor for shorts. Because generally speaking, in times like COVID, GFC, people would rather have dollars than euros. So, well, actually, GFC I don't think was the same case. But generally, if we're in a position and a black swan event happens, we will be on the right side because we're shorting always. So that was one of those things that was like, oh, maybe I should just position short. But again, I'll go into that properly in a different video. All right, let me catch up. I'm a bit behind on the chat here. It's advanced stuff. It's not really. It might sound advanced, but the concept is really simple. But the management behind DCA and how to actually do it can be a little bit complex, which is why I would never say for a new trader to dollar cost average, because you need to be able to understand how to find your average price, but also you need the discipline to be able to just cut the trade. You cannot think, oh, I'm going to sit here. You know, let's say I sold here and the market came down. I was like, yes, I've caught the top, and then it just rallies against me. I can't sit there and say, oh God, it's going to come back. It's going to come back. I'll add in again, and then it rallies more. I'll add in again. That's just gambling. You have to be able to say, okay, this is a losing position. On this pullback, I'm going to cut this. My average price is now here. I need to add in again at this point. And that's basically that's why it can work, is because you're managing that average price like a professional and not just running up a huge losing trade, counter trade in the trend. But actually the other thing is looking at the economics. Obviously, if you've got a super bullish euro and a super bearish dollar, it's pointless to do it. So if accounting for what's driving the market is obviously a big thing as well. I didn't mean to start a whole debate about scammers. My bad. ICT alone and bankrupt you. Yeah. The thing is, I don't really have an issue. I think I've said this before. I don't really have an issue with like the SMC stuff. The core concepts aren't actually anything useless, I would say. I think the problem is ICT himself, because it's not a case of, okay, guys, I'm going to teach you how to use this strategy. There's an order block at this point. Liquidity swept here. So once we've had this 50% pullback here, then we go long. I'm fairly sure that's something the SMC guys would look at. That would be fine, and that would be a relatively set rule thing. But the issue is with a lot of these ICT guys is there is so many different approaches, and it's so discretional. It's almost impossible to have, or at least start off with a working strategy that you can then build from. Because it's like, you've got the unicorn thing, you've got breaker blocks or whatever, you've got the silver bullet, you've got all these different things that can work at the same time in different directions. One person's doing one thing, the other person's doing the other, and there is just no structure whatsoever. And I think that's the biggest issue, is there's no way really to be able to sit there and say, okay, I've got it. I understand what I'm doing now. And also the terminology is awful. I think there's a huge problem. It's like, there's an order block here on the 5 minute on NQ. That's where all the institutions are going to add in. But wait for that liquidity sweep, because trust me, JP Morgan is going to trade NQ on this order block. But before they do that, they're going to take out your stop. A load of nonsense. I wonder if I can have a week of streaming where I'm not bashing on ICT at some point. I do apologize. I don't come onto these streams with that intention. It's just sometimes, we'll end up rolling around in different topics, and that's where I end up. But I'm fairly sure I watched actually a guy called Sam KB. I really like him actually. He was on Words of Wisdom about a year ago, and I watched his podcast with him a few days ago. What was I going to say? Oh yeah, he's got a really, really good approach. So you've got traders like me and Nick, where you're essentially not trading statistics in terms of like, on Monday we're looking at a 70% candle. We're not trading like a mechanical thing. It's more based on economics and very simple levels. Whereas you can get other traders with the approach where it is pure technicals, but it's all backed up by a mass amount of data. So it's like on Tuesday London session, if we get a doji at 9:30 followed by a bullish candle of at least 20 pips, so we've got an 80% chance of this happening. Those types of strategies can also work, but it's rare for a retail trader to do that because it takes a lot of time to try and build something like that. Yeah, Alan, the jet, no problem at all. If you need it next time, you're more than welcome to have it. I hope you didn't fall over that the stack of cash that I left on the floor, though. I forgot to pick that up. I kind of got distracted when I was getting into the Bentley. I trade only to make $200 a day across 4 accounts. I'm okay with $800 a day. Fair enough. If that's your goal and it works, then yeah, go for it. I'll give you an example. Look, SPX from the low of 2023 until the high, you can see recent move was around 60%. You'd have to draw it. Yeah, I think the fib is great. And I think a lot of the, well, actually, I'm just going to say the fib. I think the fib is very, very good because it's self-fulfilling. It doesn't always work. Obviously, nothing always works. But it's one of those things that a lot of people look on an aggressive move one way. The only real thing you can do is wait for a pullback. And those pullbacks, the majority of people are waiting for a minimum of 50%. So if you're in a massively trending market that's driven by great factors like fundamentals or geopoliticals, whatever it may be, you're most likely going to look for that 50%, regardless if you actually use the fib or not. 50% is like the benchmark for a pullback. So if you've got enough people looking at the same thing, that's why it works. So if you've got something super complex and super weird, sure, it could in theory work, but how many people are going to be looking at that same thing? And that's why, supports and resistances for day traders or scalpers likely aren't that useful. But for a position trader or a swing trader on the weekly, monthly time frame, daily time frame, there's a lot more eyes and there's a lot more capital looking at that same level. Leave the keys under the mat. I'm fairly sure if you're going to get onto my jet, the butler will bring it to you, or my assistant. But yeah, you bet I do have a Bentley. You'd be losing that bet. I actually don't have a car. I'm too frugal for one of those. I'm like Scrooge McDuck. Actually, I can tell you the sort of mindset I'm in. It's always looking for opportunities, never liabilities. And a great example of that is when Trump tweeted about his meme coin. I was quite literally watching it go up 1,000% with one of my friends on Discord. We couldn't get in. The Solana chain was down, I was fuming. I was so angry because it would have made me a multi-millionaire. I'm not even joking. But I missed it. And then anyway, I ended up getting in a little bit late, lost about $200, nothing big. But I would rather have a little bit of an attempt on a meme coin by the president than buy a car. Because I just don't need a car. I Uber everywhere. Oh, Alan. Yeah, same thing then. I think America's slightly different because America, I'm fairly sure you need to have a car there because the roads are so wide and everything's so far apart. But the UK, it's easy to get around here. Yes, I was Royal. I saw you liking the post and I was like, oh, who's this guy? Small world. Euro dollar. I'm bearish euro dollar. I just don't see anything that great for the euro. I think the dollar is struggling as well from a data side of things. I wouldn't, and this is annoying. Well, not annoying. That's not the right word. I'm conflicted because I am very bearish on euro dollar. Because if we're going to break it down, I just need to be very cautious of time. Okay, Chris is here, so I'm just going to very quickly cover euro dollar before I go. So euro dollar, in my view, the euro was supported heavily by two things. It was the dollar outflow and it was the German stimulus. The German stimulus is priced in. That's not really a factor anymore. There's been no developments. It's done. The dollar was significantly losing value due to trade. Due to tariffs. There was a lot of speculation and fear around that. We're seeing that sort of cool down. But the price isn't reflecting it. I think we still have a lot of correction room down here on euro dollar. Definitely not looking for parity. I just think we can come lower. Anyway, guys, have a great one. Chris Pulver is here to take over the show. I apologize we didn't get around to many charts, but it is what it is. Have a good weekend, guys. Enjoy your Friday. Stay safe, and we'll speak probably not next week, week after. See you later.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat and you can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show.
Well, what's happening, everybody? How we doing today? I am looking at a potential broken wing butterfly this morning. Just got out of the trade. I had two winners on SPX this morning. Watching to see if we're going to have some flows. I was looking at some unusual whales, 590, 595, 600 on the SPY today. That's a lot of direction. We do have I think it's a triple witching OPEX cycle, which means we have expirations today on stocks, ETFs, indexes, futures. Next week on Wednesday, we have a volatility. This is the VIX expiration. So, I mean, I looked at Mag 7 this morning. There's some gamma levels that are interesting to the upside, but it's a little bit overstretched. I mean, Apple's expected to move about $1.50 today, and the move I'm watching is like a $5 gamma level. So I don't think we're going to get that much volatility today. Anything could happen, but I was curious, like, well, if we're not really going to go down, then maybe position myself for a little broken wing butterfly that has a profit trap today. That trade might work out for another 45 bucks. Let's see here. I'll move this a little higher on the chain, 65 cents. 58.95 is where on the price today. 58.95 is down below yesterday's low. I don't know. We're also trading in a pretty low volatility environment. I don't need to force a trade. I mean, I've had some decent winners this week. All in all, trying to think here. 12th was this week. Yeah, I mean, net pretty good. I'm closing up a winner today on Shopify for 106%. Got a bunch of covered calls are getting called away. GLD, Max profit. DraftKings had a winner. Johnson & Johnson having a winner. Dow. Let me check the old Dow. I had some naked puts this week. Had some 1-1-1s. IWM. Fine. Where's my DIA at? There we go. So naked puts now trading for about 86% profit. I'm just going to let this one hang out over the weekend. I mean, if this comes in with 90+% on Monday, I'll just take the profit. 345 max credit, almost up to $300. Could I wait an extra 45 days? Of course I could. I don't really want to. So most likely, if this one crosses over $300 by end of today or going into Monday when we open, then I will close these up. Same thing here, up about 80%, $200 max. If I get this to 175 or 180, look to close out majority of the profit. Same thing here, same thing here. So those are looking pretty good. Those are out to June, but I'm going to close those up a little bit sooner. Let's see, AT&T closed out some puts this week. CB, this is going to be a full winner. This is a ratio spread. So up about $600. That'll close out by end of day today. NVIDIA naked puts, I close those out this week for profit. Collar trades running out to July. That's fine. Naked puts. It's up 70%. Pulled in 350. Same thing here. This one, if this gets up to like 75 or 80% max credit, start pushing up near $300. I don't really want to hold this for a full cycle out to December. So it's looking better. I'll just let time do its thing. UNH took the brave move on UNH. This one, I can't believe this hasn't closed yet. I literally have a credit sitting at $1.99. It won't fill. It's going to max out at $2 today or settle over the weekend. There's just no bid ask prices where I'm trying to close it. I was working on a transfer yesterday for one of my clients, and I had to close up a collar trade on silver. And I mean, it's 100% profit on the collar trade because it's, the put's worthless, but the covered call is full credit, and I couldn't even get it to close. So I called the Tasty Trade desk and I was like, just let it close on the weekend, let it expire, and then I'll do this transfer on Monday. So some of the bid ask prices are a little bit zeroed out based on some of the strikes I've already put in. I want to take a look at AT&T. All my naked put combos are looking okay. Again, pulled in $6, up about 60% of that. 25, 22, and 20. Trading up to 27 on AT&T. I think I like buying the dips on that. I think the structure of that chart looks pretty decent. To me, that was a value play from the teens. So we came down to like $16, $17 in AT&T. I've been buying it since that level. Still participating in the low 20s, but there's decent amount of premium I'm collecting on that one. UNH. So I took the ratio spreads. And already, so I pulled in a ratio spread for $424 credit. It's already up $200. Like literally, I took this trade yesterday. This trade's already up 50% in a day. That's not too bad. I mean, that's not too bad. So here's what I'm going to do on UNH. I think I'm going to sit on the weekend, like let this work over the weekend, get that extra Saturday, Sunday time decay, come into this trade on Monday, and see if this is up towards like 55 or 60% and just take the profit. Ideally, I mean, pulling in 424, if I were able to close this thing out for, $300 or $400, that'd be pretty nice. But I also have the 260 by 270 ratio spreads, which are still down quite a bit. That was, that's a nasty spill, obviously, with like that much. It's a naked put. So I mean, the 260 is technically a cash secured put that I would be taking assignment on, but the expiration is also out to January. So there's still lots of time in the trade. Question comes in. I've been searching your channel for a while for a good video on dollar cost strategy. I mean, I can do one on dollar cost averaging. I'll throw one on my video. I'll write that down. Dollar cost averaging. I'll just throw it on my YouTube channel. Okay. Now tell me this, dollar cost averaging into what asset? Because it's not always going to work. I mean, assets that are tending to go higher. I'll give you an example where it works really well, an example where it works like garbage. Here's an example where it's been a struggle bus, but you got to ride through this stuff. Like here's Meta. Okay, if you dollar cost average in Meta, from, let's say, 2018, I'm just picking a number here, you dollar cost average. Okay. I mean, in my opinion, a dollar cost average in a stock would be, 10, 20, 30, 40, 50%. If those are your pullback levels, you have, let's just use a simple example. I'm going to say, okay, I'm going to invest 10K in this stock. We'll just use a stock, right? So 10% pullback, 20% pullback, 30% pullback, 40% pullback, and 50% pullback. Now, again, you'd have to have the case. Oh, you're talking Forex? All right. Well, I'll do a quick stock example, then we'll go Forex. If this was a stock and you believe like this stock is going to go higher, I like this stock, I want it to go higher, then a 10 to 50% allocation, you take your $10,000 or whatever number you want and then splice it up. So this would be 1, 2, 3, 4, 5 installments. So that'll be a 2K installment on each one, right? So you put in 2K, another 2K, another 2K, another 2K, another 2K. Now, if you don't get the pullbacks, you don't get the 30, 40, 50% pullback, that's okay. You can just keep the, $4,000 invested, keep the 6 on the sidelines. And if price goes higher, that's okay. And when you are, this $4,000 is up a certain amount, you can peel that profit back to 4K, still allocate, look for the same thing, like kind of reset your numbers at, all right, if from this high, we get a 10, 20, 30, 40, 50%, I'll still kind of keep the same game going with the allocation. Bigger picture is you're trying to invest in something that's going to keep making highs. That would be the stock market. Forex market is a little bit different. Okay, Forex market, I'll give you lots of examples, dollar cost averaging, because I've been doing it a lot in the Swiss crosses. So here's the dollar cost average on a Swiss pair, right? So right now, actually, you know what? Let me go Aussie New Zealand. This one may be a little bit simpler. So Aussie New Zealand, if I were to dollar cost average, let me go to the bigger time frame, and this is what I'm doing. I'm using typically larger time frame support resistance levels to dollar cost average into. I'm not talking like dollar cost average into short term. I think that gets you into too much trouble if you get on the wrong side of a bigger move. So if we look at the bigger picture here on the daily or weekly chart, we've got these major lows back in 2018. We have this major low back in 2015. So, I would be willing to invest in the Aussie New Zealand and say, if we hit 106 and we hit 103 and we hit 101, I buy, I buy, I buy. Price levels for profit would be anywhere in here, right? So profit target, and 106 to, let's say, 112, 103 to 112, 101 to 112, monster profits, like monster pips. Could it take time for those trades? Of course. When it bounced up here, it took months, but they all paid. Make sense? And the same thing is true on resistance. I mean, if you thought, well, it can't go much higher than this level or this level or this level, then you can sell here, you can sell here, you can sell here. You still want to have a plan, I mean, I don't want to sit here and like, if this breaks above 116 and wants to go to 120, it's like, I don't want to ride that to the downside. I don't want to be stuck in the wrong side of the trade. So you still have an exit plan. But the bigger picture of me and as a Forex trader is, if we have strong support resistance, I like to buy supports. And even if this is a, trade 1, trade 2, trade 3, if trade 1 is a losing position, but trade 2 and trade 3 can get me back to break even, you can take the winner here, take a small loss or a break even, close the break even, take a winner. You survive the trade, you let price do its thing, you trade the efficiencies, you trade the equilibriums, you trade the reversions, you give yourself a lot more time. Make sense? So in order to dollar cost average, you do have to trade, in my opinion, you have to trade really small. I trade very small in the Forex market. If I have, a lot of my master accounts over the years when I did Forex was either a 50K account or a 100K account. And then I had a client's accounts that were linked to that, and they would just copy the trades. So that master account was just easy numbers for me to do the math on. So like 100K. I rarely used margin with my Forex accounts. Even though I'm a US trader, I have 51 leverage. I rarely use leverage. I rarely used like more than, I'd say, 70% of my margin. So, I mean, if I had a $100,000 account, I would trade literally micros and minis. until they built themselves up to multiple mini lots or multiple standard lots. It was rare for me on the 100K account to have one position on a currency pair that would get more than like 1 or 2 standard lots. But if I build that position up, let's just use this as an example. Okay. If I did a dollar here, dollar here, dollar here, just so it's going to be like, 0.14 mini lots and it ends up being $1 a pip roughly. So I could take about a $600 drawdown here, okay, about a $300 drawdown here, and maybe a $50 to $100 drawdown here. So for about $1,000 risk, I could play big areas. And for $1,000 risk, I mean, I'm putting a 1% risk on the table with the probability this market doesn't necessarily go below my level. So I don't have to really risk more than 1% in the trade. But when I take trade 1, 2, and 3, okay, so I'm in to each one of these trades. If this trade pays me, this one gets me back to break even. What's my payout? And on top of that, if I find a bottoming pattern, I can also still add, positive trades to a price pattern that I think, okay, we got a bottom. I'm going to start adding to this winning trade. I do have a video on that. I talk about, adding to winning trades. That's in one of my Keep It Seriously Simple videos. But I'll just do the dollar cost averaging here. If I did trade 1, 2, and 3 and trades 2 and 3 paid me, what would that profit target be? Well, that one would be up about $300, and that one would be up around $540. So we're looking at a net around $900. Okay, $900, and I don't even have to win all 3 trades. I could take this one like break even, winner, winner, and I make $900. My max risk was about $1,000. So, I give the market time. I give price plenty of room to breathe. I'm not getting stopped out and wicked out at all these crazy turning points, and I can still make some money in the trade. I'm only adding to those key levels. I'm not adding anything to my winning side, which would really be the critical spot to making this a very profitable type strategy. Is when you find a strong bottom, I like to also add buy stop levels in that direction. So I have trade 1, 2, and 3, but if we bounce here, I want to be adding back up into level 1. So I can still take level 1 as a break even, but if I added in 1, 2, 3 more trades, those can pull out little winners. Maybe I can edge this out to, $1,100 profit or $1,200 profit. And then I can actually make more than what I was initially risking on the dollar cost averaging. Make sense? So summary is this. If I'm dollar cost averaging, which I do a lot, it's higher time frames, it's key support resistance levels, and it's trading very, very, very small. It's not complicated. It's also not super exciting. It takes me sometimes months to get profits, but if you ever look at my January to December performance, it usually looks something like this. From January to December, it would be, let's say, I'll just type this out here. So if we have January, whatever, I don't want to, you get it. There's going to be like some histograms here. It would be, a little tiny month performance, maybe a little tiny drawdown for a month, and then a big chunk of profit, right? And then another little performance here, and then another chunk of profit. So it would be in a course of 12 months, I'd have like 3 or 4 months that would pay me like 8 to 10% of my account. And then the others were just like little ups and downs of ones and twos. But my chunks were always, 6, 8, 10%. And so I might burst up to, 25, 30% for the year, give back a couple, on some drawdowns, carry some drawdowns in some of the positions I'm in. But, net on the year would be around, 20, 25%. And it wasn't terribly complicated. I didn't have to use a lot of leverage. I didn't have to stress about the, intraday swings. I didn't have to stress about the noise in the market. But it's patience. I mean, and a lot of you know this, but my initial starts in the Forex market was scalping as a day trader on a 1-minute time frame. Like I was in the trenches every single day, grinding out 20 pips a day, and it was just so much more stressful. That's not my personality. I'm way more just, I want to be even keeled. I don't want to be emotional when I'm trading. I hated like when I could feel my heart literally beating in my chest. I thought that was way too much like adrenaline for a trading. For trading, it's like it's not how I want to trade every day. So long story short is I went to bigger time frames. I took out a lot of the the time stress, and I just kind of patiently let trades come to me, find big levels, and those big profit chunks pay out. So it might take months for a trade to come to fruition. It might take months to get the profits that you want, but over the course of the year, if I could still net, 20, 25, 30% for my accounts, I was doing really well. And I wasn't using a lot of risk. So, my risk adjusted returns were pretty solid. I had drawdowns that were pretty manageable, and gains that were almost double that or better. That makes sense? Would you say it's your go-to for Forex? I mean, this is definitely how I trade. Like this to me is my preferred way of trading. Like this is how I survived the Forex market, running a currency fund for over a decade and did really well. And I survived, the 2012 yen. I survived the 2014 dollar. I survived the Swiss National Bank crash in 2015, Brexit in 2016. We had a vol event in 2018 and flash crashes in 2018, COVID in 2020. When I really started to move away from Forex, this is no joke, like 2022 was the year that made me the most angry because everything changed with interest rates. And I was watching good positions get punished by negative swap, even though it was a positive swap environment, but it hadn't been passed on to us as traders. And I mean, I'm managing a fund, man. I mean, so I'm like positioning into Swiss pairs and trying to exploit this like 4% rate differential. And I'm getting charged every day to do it. And I was furious. And in 2022, it's like that was a bear market year for the markets. I did actually, net out some profits in currencies, and it's what saved my portfolio. I mean, I ended up making money in 2022 because of currencies, but I was so angry at like every single day my broker is charging me, between all of my accounts, I was probably losing, I don't know, hundreds of dollars a day holding positions that should have been a positive 4 to 5% swap. Like, and I held it for months. I was holding trades for 5 or 6 months, and then of course, like January 2023, it turns and I start noticing positive swap, and I'm like, I just felt like I was getting robbed for 6 or 7 months from negative swap. So I just thought, like, F it. I'm just gonna migrate into options. I trade Wimmer options. I'm just, my risk is better. I don't have any swaps. I just pay a one-time commission, and options are just much cleaner. So I still like Forex, and because we've got positive swap now in the Forex market since 2023, I've been hanging on to Swiss crosses since then, and I'm dollar cost averaging those Swiss pairs. They'll pay me. The Swiss pairs will pay, and I'll honestly, the nice thing is since I've been holding it for so long, I'm probably going to double my account, and it's not going to be, oh wow, I doubled my account this year. It's like, look, I've been in these positions since 2023. So if I double my account, it's going to work out to be somewhere between 25, 30% annualized over a 3-year window or so. That's still pretty good, right? For something that's like I spot check a couple times a week and just make sure nothing crazy's happening, right? So yeah, but it's, I don't know if it fits everyone's style. I've had a lot of traders follow me over the years. If you are a bigger picture trader, if you're a position trader, it's a little bit easier. I think it's a little bit easier. You can let great trades come to you, and I would say in a given year, I mean, I find, let's say, a dozen great trades. When I identify a great trade, to me, it's like I'm going to put in 10, 15, 20 positions to build this trade from start to finish. And when those trades are done, that's usually what this profit chunk looks like. That's where I can turn, 7, 8, 10% gains in my entire account on one position because I build it, right? But I start it with like little tiny building blocks. It's tiny, tiny, tiny. And I will literally take like 50-cent pips, 50-cent pips, 50-cent pips, dollar pips, and average it into, maybe adding up to eventually like a $5 or $10 position. And I'll still add to it until I get to my profit targets. And, I've got exact levels I want to see price go to. I have, good enough levels that I'll take profit at. But I do a lot of symmetry measuring in the markets. I do a lot of pattern trading in the markets. So when I see a good price pattern, I tend to, watch it, measure it, look at my waves, and have the patience to hold it. Can you trade options on a simulated account? There are a couple brokers that, yes, you can do that. I know that Thinkorswim's platform, if you have like a Schwab account or a Thinkorswim account with TD Ameritrade, which is now owned by Schwab, their platform allows you to have like a 100K paper account. You can trade options with them. Yep. I think there's some other ones that have. I think E-Trade might have a demo account as well. Webull, I think, has paper trading. But yeah, you can trade options on those. Okay, does that make sense? So little rabbit hole there for Reverie, but hopefully that makes sense. Okay, top down today. Markets are flat. I mean, this is intraday price action on the SPX. Boring, but good for me. Took 2 winners this morning out of SPX. I'm trying to eyeball maybe another directional trade for the morning, but I think I'm okay. You know, like I said, I've got trades are closing up. I'll sit over the weekend, double check a couple of things. We should have decent chunk of profits. I mean, I've got lots of income trades this week on some cover calls that I rolled. Took a winner on HIMS on a diagonal spread. Took a winner on a ratio spread, AMD. Rolled calls on IWM. Rolled calls on Tesla. Rolled calls on MicroStrategy. Cover calls that I'll be adding to it. IBIT, Snapchat, Pfizer, Silver, which SLV, Baidu, JD. Win on AT&T. I'll look at the Dow next week. Johnson & Johnson was a winner. I want to take a look at UNH. That ratio spread I put into the pulver alerts is already paid 50%. Over the weekend, if it's up like 55 or 60%, then I will probably just take that trade off. But also probability with the IV changing so much. I mean, this yesterday, I don't know if you saw this with me yesterday, but this IV rank was a 150 yesterday. Like insane. Also, if you look at the, let me just go to a simple like overbought or sold condition here. Let's go to this chart is a little messy, so bear with me here. But I looked at this yesterday during my YouTube session. Check this out. This bottom chart on the daily time frame. This is the daily relative strength. I've been trading for a long time. I don't think I've ever seen a relative strength index get down to 12. I mean, we're talking like 80-20 is like, oh, wow, it's way overbought. It's way oversold. I've seen the oversold condition. I think it was on, oh, fudge, what chart was it last year? Was it Palantir? Something was like in the 90s for overbought conditions. Like the relative strength was so pinned to the top. It was like 90. Maybe it was NVIDIA. It could have been NVIDIA. Anyway, it was just a sign of like, yeah, this thing's overbought, you know. Anyway, but we're down here at like 12. So, I mean, look at this. This goes back to, 2014. I go back to a weekly time frame. It's like, we're not going to see this on any time frame. You look at the weekly chart. Weekly chart here, the value is like, 20, but it's way back here in like 05. So I mean, obviously that's a pretty rough patch from like 2000 to 2008. Weekly chart is still oversold, but the daily chart, good Lord, daily chart, like one of the most extreme things I've seen in a long time. So that is why I decided, look, Ivy ranks at 155. It's just a trade. I know it's a ratio spread if you're not comfortable with the kind of cash secured put, but the probability is that expected move is going to be way more than the actual move, which is what I try to take advantage of when I'm selling options. So far, so good, right? I mean, because of that, right here, I mean, that ratio spread is already up, 40%. Now, a little bit more time. I mean, this is out to July. It's only out 63 days, which is a lot of premium to pull in for a 60-day trade. But I also think that the expected move, I mean, with this Ivy rank already down to 108, if this thing gets back to 100, 95, 90, the IV just kind of contracts and reverts, then this most likely will be a very easy winner. So I will probably protect this thing around, I'd say $350 to $375, and just take the profit and do it well before expiration if it's offered that way. But it's not every day you find a trade that's just that ridiculous. I had a question pop up like, what's your favorite stock? I'm like, honestly, it's not my favorite stock, but it's my favorite trade right now because it's just such a good opportunity to see that the expected move and the implied volatility move is so much greater than most likely the actual is going to be. So pretty wild stuff on UNH. But anyway, like I said, that chart's messy. All right, let's keep going. Let's take a look at the heat map this morning. I want to look at some levels. We are pushing a little bit lower on SPX. We did break the morning range here. So it's fine. I mean, I think that this market is still very much due for just a pullback. Just a pullback would be great. Does it pull back into this area, this 5,800? Do we actually come back and try to fill this gap at all? Fine. I do have a 590 by 580 bear put spread on the SPY. So if we pull back into 580, I'm looking to grab some profit there. It's not bearish. You know, like I'm not bearish on the market. All I'm looking for is just give me something to buy a dip on, would you? So I'd love to see a little bit of a pullback. You know, even this area it's very shallow, but you know, maybe this market is just like that's all you're going to get is that little 2 to 3% dip, and this market just melts up until we get to highs. You know, data is showing resiliency. I'm flabbergasted by how quickly the sentiment has shifted. I saw Nick post this morning, but you know, we've got the put to call ratio. It's like we're getting into extreme greed territory now. The CNN fear and greed is showing the same thing. I mean, we've went from this was down to like 20 or less. This was like a 20 when we had March and April sell-offs. Like this was extreme fear, and here was just like, nope, it's greed again. But you know, market momentum. I don't think this is accurate because we're above this, but we had such a big recovery to get back above the 200 moving average, and our moving averages haven't quite crossed over yet, like the 50 and the 200 or the 100, the 200. They're not all pointed up yet, but stock price strength back into greed territory, breadth, extreme greed territory. Here's your put and call options, greed territory. So that's what you're seeing here in the Edge Finder, right? I mean, if I could go back further on this, I'm curious if I can go back. I mean, I want to see if we can go back like a couple of years, but you don't get a lot of these big swings in such a short amount of time. That is a big fear swing, and this is a big greed swing. And look, I think naturally the market overshoots either direction. It overshoots on the fear side, it overshoots on the greed side, and reality is going to be in there somewhere in the middle. So I wonder, like, if the market doesn't quite have what it takes to get to all-time highs, do we have just a little bit of settling? Do we settle back into here for just some, pausing? Is this market just destined for just crazy amounts of direction? I did think about this a lot this week. I don't know if we expressed it like explicitly on these sessions, but I think we could be going into like another global bubble situation, because now that the US is at least shown some very quick resiliency, the Eurozone is still performing well. And they're not like, nobody is flawless here. Nobody's flawless, but the US is showing resiliency. The Eurozone, Asia, mainly China, Latin America, emerging markets, they've all been performing pretty well and outperforming the US this year. Okay. As long as the US remains resilient, I think other countries and non-US performance will be good. So, easy way to watch that. I'm trading this. This is SCHY, which is an international dividend ETF. There's also international growth, right? But I have this stock it's an ETF that I bought down here around like 23.50, so near the lows, and we're back up towards the highs. This is mostly Europe and US based, and then my ILF and EWZ for Brazil. I've been waiting on these in a multi-year kind of downtrend. I was going to buy more around 18 if we hit ILF at 18. We didn't. Brazil was a little bit closer, so EWZ a little bit closer to like the COVID levels. Okay, so I took some stabs in the low 20s. Now, like I said, non-US could perform very, very well. You could look at the MCSI. So here is MCSI X the US. Okay, look at this thing. This thing is at fresh highs. Okay, so that recovery has been way more robust. That is up around 20%. And if the world is going to outperform the US, then you can take advantage of it a lot of different ways. Now, I don't know how sustainable it is. I think that if something were to happen where the US is troubled, it's going to weigh on the world in a big way. So, long story short is, if this is Trump and company are pivoting now to like more fiscal expansion, we want to pass this big tax bill in July, and what comes into that, I actually found a little snippet which I think would be interesting. I wish people would care enough to do the research, but here's what's happening with a bit of the highlights in the tax bill. There are tax cuts, okay, but there's a huge change in Medicaid, which is basically like your Affordable Care Act that gives everyone a chance to have some health insurance. What is the reality of this? And this happened under the Obama administration. But if you are barely working, if you're not working, if you're unemployed, but you still have government assisted healthcare, they're going to kind of phase you out. So you have to show, like, I mean, just the harassment of, like, you have to show you're at least working at least 80 hours a month, or the amount of paperwork that's going to go into like maintaining coverage for you or your family is going to be a lot harder. It's going to be difficult for, lower earners or lower income brackets to maintain coverage, and they're going to be pooled into everybody else that is insured. And guess what it's going to do to healthcare costs? Drive them higher. Okay. Immigration. This was interesting. The bill would increase funding to help build a wall for the US-Mexico border. Wasn't that Trump's big plan in 2016's campaign? We're going to build a wall. How well did that go? We're doing this again. We're putting this in a freaking tax bill. So here we go, round 2. We're going to build a wall. Cool. Clean energy. We're essentially doing it with clean energy and deregulating. And then more MAGA savings. We're going to give $1,000 tax credit and the ability to contribute for tax-free until your child's 31. Well, most likely lower income families won't be contributing anything. They'll just take the $1,000 tax credit, hoping that they can get more money per kid. But it's what I'm saying is, like, all the crap that is putting these bills to get passed. It's ultimately going to be the same thing we've always seen in the U.S. in the last 25 years, which is the haves benefit, the haves not. I mean, yeah, maybe there's a bit of assistance there, but it's like, it's just going to make stuff more expensive. And I just don't know how this ends. I don't think that I think the plan to roll out this global trade war was good in theory on the the sounds and the marketing bites of, we're going to cut government spending, we're going to balance the budget, we're going to decrease the deficits. All that sounds great, but April showed us how difficult it really is. And I don't think it's going to go back to that at all. I think Doge is over and done with. I think this whole idea of trying to drain the swamp and cut government spending and cut the fluff and corruption doesn't exist. This is what broke the market. When this pivoted hard, and basically look at your bonds right now. I mean, the U.S. is continuing to see a multi-year drawdown in the bond market, and I think less and less and less bond buyers are going to be like lining up to buy our debt. I think the U.S. Treasury might have to get pretty creative here. We might have to start issuing different durations. Most of the government has been surviving on short-term duration bond yields. So what we're doing is we're offering auctions at like two year. So it's very short term. And I don't know what happens. Like, the Fed could very well cut rates this year. Okay. And we, as I mean, let's say U.S. consumers here, we might not see the benefits of any of it. Okay. If the U.S. cuts this year, so here's probabilities. They paused. They're looking like there's a higher probability pause again for July. So now the first rate cut probability is in September. Okay. I mean, I'm fine with Jerome Powell, like, sticking to his guns, not cutting rates early, not trying to cut rates because they potentially stoke inflation. Look, inflation will be the killer here. Like, Jerome Powell's legacy, if he ultimately does find a way to tame inflation, even if they adjust the inflation target from 2 to 3%, right? Like, we've had 2% for all these years. If they adjust it to say, look, we have realistically been running around a 3% inflation level, and we're willing to accept that with our economy, like, they can adjust it. It doesn't have to be this, 2%. Like, maybe it's impossible to get there, but 3% is more realistic. That's about where we are. We had headline inflation at 2.3. But my point is, I hope that Jerome Powell doesn't bow to, like, stupid pressures and tweets and whatever about, Mr. Late, Mr. Loser, whatever. It's like, shut up, dude. Just let the Fed do its thing. They're not here to proactively do anything. The Fed is here to reactively backstop and save things if they have to step in. And it's manipulated, and everybody knows that. But you're glad you have the Fed. 2023 with the regional bank crisis, Fed saved it. 2022, after we got into the little bit deleveraging, Fed saved it. COVID, Fed saved it. 2018, Fed saved it. 2000, like, all these years we've had nasty pullbacks, Fed saved it. So that's where this whole Fed put's been in place, right? My point is, if the Fed cuts rates, okay, does it actually change anything in the housing market for U.S. buyers? Maybe not. Does it change anything for buying a car? Maybe not. Financing on like 5, 10, 15, 20-year terms may not change at all. Businesses trying to refi for 5 years, 10 years, it might be at double, triple the price of what they took out loans in 2020. billions and who knows, trillions of dollars taken out during COVID in loans that'll never be paid back, but they could be refinanced, but they're going to be refinanced at multiples higher. So I don't know if even cutting rates from the Fed this year is going to be beneficial to the average business or the average borrower. I have a feeling like we might not see any of the benefits from it. So it's going to be weird how the lifeline is way more expensive and how that doesn't hurt growth going forward. Not to the point of stagflation necessarily, but to the point of, holy crap, the U.S. is slowing down. These valuations are excessively high, and I don't know how much longer we can run at these high valuations. So big picture, I think it all shakes out eventually. But if the government's going to spend money and the Fed is maintaining stability and the Eurozone is going to spend money and China is going to spend money and all these countries are willing to add fiscal policy, add fiscal spending, like the U.S. has done for all these years operating with these deficits, a global bubble could certainly exist. So as rational as we want to be about it's unaffordable. These valuations are crazy. You can't have these high prices. If everybody is spending and money supply is increasing, stocks will go up and probably go up by a lot. So go back to, an index. It is very possible that, as much as I want to be rational and say like, yeah, we can't go to all-time highs without having some type of pullback. Look, we can go here and we can break and pause and we can go up again and we go up again and we go up again. And this is just the dumbest correction that the market's had since COVID. Okay. And then here we are at all-time highs going into another giant bubble. That could happen. So, my bearishness is like, I know how irrational this market can get. I know how hot this market can run. We've seen it over and over again. So don't fight this momentum. I'm just asking for a pullback so I can participate in something that looks a little bit more reasonable as opposed to it just goes up. It just goes up. So anyway, that's the point. The market can run hot. I've projected, on SPX here, I think I projected I'm trying to think what workspace it was, maybe a blank workspace here. SPX. Yeah, here we go. So let's just take a quick peek here. Let's say, and I'll just make this a larger pattern. Okay, so bear with me on the drawings here, but let's say that this is a high, and we're going to form let's say we form a high in the interim, like the next maybe 2 weeks, and the market pulls back a little bit. Okay, well, this could be setting up for a larger bullish pattern. Okay, if we get a pullback here, this is still a very well supported market by the bulls, and let's measure that move. So what I'm going to do is this. I'm going to take my low to high swing, and this isn't perfect yet because I don't know if this is going to be the top, but let's say that's my low to high swing. I'm going to project, let's say we have a pullback towards this blue line or this blue line. Okay. Oops. So conservatively, let's say we pull back to like 57.50. So I'll have a projection here, right? I'm going to put a projection line in green. So we'll go green there. And if we have a deeper pullback, maybe green here. Okay. That still gets us to all-time highs this year with some room to run. We could get 66, we could get 68. Not a bad spot. Now, what happens if this ultimately is a run up into the highs and this becomes the top, and then the market pulls back for a deeper right shoulder in here? Well, then we have this swing, right? And we have this pullback. Well, I'm going to make this a little bit larger. Let's take this area, go up, and then we project the same thing. We pull back into this level as kind of a deeper pullback that still gets me to the same level. Interesting. Okay. Or we have like a shallower pullback into here, maybe a little bit higher. So it's not perfect, but I would say that I wouldn't be terribly surprised to see this market have its destination set on like a 6,600, 6,800, even 7,000 plus target. And how am I seeing that pattern? It's going to be some type of like crown pattern or some type of head and shoulders pattern. So right now, this would be a crown structure because we've broken this recent high. A head and shoulders would be, we'd have to come all the way back up here. Head and shoulders is, this is your like head and shoulders. So here's your neckline all the way at the highs at 61.73. If we break that, I mean, measure symmetry, measure the projected move, right? And that's just on symmetry. If I want to go one step further, let's say this is a swing back to the highs. If this is a head and shoulders trade, then you measure it out here. And this thing's, we're talking, 75. Now, that's likely not going to be hit this year, but 7,500 is reasonable to think in the next couple of years if we just continue to push through these pattern measurements. So just saying, like, don't fight what is potentially global fiscal spending. It's not just the US doing it anymore. I mean, you have to remember, post-COVID, how'd the markets go up post-COVID? The US. That's how the US was labeled with American exceptionalism. That's how the US was performing so well, because we were just operating at a massive deficit every single year. The Biden administration was extremely favorable for global flows and anyone that's been investing. Like 401ks did extremely well. Pensions did extremely well. Anybody in the markets did extremely well. We had very few hiccups from 2020 outside of COVID, which wasn't Biden. It was like Trump was done as president 2020. Biden takes over, right? Again, and he's a puppet. Like Biden was an 80-year-old with dementia, and he's our president. So I'm not giving Biden credit. I'm saying, like, as an administration, it was spend, 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 deficit, 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 Fed. We had a deleveraging in 2022. The market had a 25 to 35% deleveraging event. That was it. We got out of it from how? Fiscal spending. What were the last couple of years? Everyone's calling for a bear market. Why? Because, well, the Fed's been tightening. Well, the government's been spending a crap ton of money. So now if you have the world that is now joining the same thing, Euro spending money, right? Eurozone spending money. US is going to spend money again. China is spending money finally after 4 years of lockdown. Global money supply, global liquidity. That's where the next asset bubble is. So all of us know here that these markets can run hot, and the famous saying from John Maynard Keynes is markets can remain irrational longer than traders can remain solvent. The nice thing is when the market remains irrational to the upside, just don't be an idiot and try to call the top, and you can make a lot of money, okay? All I'm asking for is the market to pull back. That is all I'm asking for. Give me a pullback, please. This would be great. This would be outstanding. Even if we pull back into here, I would still think this market is postured for bullishness, and I will take my stabs. Okay? So a pullback, I'll nibble. A pullback, I'll nibble. A pullback, I'll nibble. I will probably be selling premium. And if I'm going to take assignment on any shares, I'd be doing it way below the lows. But if I can nibble here for all-time highs, all-time highs, all-time highs, those are great income trades for now. And that's my next plan is give me something on S&P, give me something on NASDAQ. Dow is fine, but UNH sucks so hard that UNH has been dragging the Dow down. Russell, I don't love the Russell because I know that most of the companies don't make money. I like the Russell because it's not so aggressive with the market cap weighting like the SPY and the Qs. And so that's why I opted to buy it. It's cheaper. So I'm buying shares of the Russell so I can sell premium against it. And I'm just using it as an income vehicle. But if I'm looking to own shares, it's like I want to own SPY at a discount. I want to own Qs at a discount. I can own those. That's why for this entire move here, all I spent time doing was selling premium, collecting income, and with the cash that I've raised, I want to deploy that. I want to be a bigger picture investor. I think this market can go higher. I'm just asking for a pullback. Why am I so political? I'm not political. Nothing about what I'm doing is political. Okay. I am a centrist that hates politics, that wants to trade. But unfortunately, politics has seeped into the market so heavily that we have a politically driven market. Trump literally tweeted, it's a good time to buy. What president's ever done that? None. What president's on the economic calendar? None. So politics is now integrated. So look, I'm a centrist, man. I seriously hate politics. But you have to understand that this political scene is way more tied to what these markets can and can't do. So it's all blended together. So I am a technical trader that is fundamentally aware. And I think if you're ignoring that stuff, I mean, I mean, good. I mean, you can ignore a lot of the noise, but the bigger picture is I think this market can go into another bubble. And how do we do it? Because everybody's spending. If the US is going to pivot hard and spend, and Eurozone is spending and China is spending, that is fiscal policy. That's how these bubbles are created. And this is no different than what we've seen since 2018. It's ups and it's crashes, and it's ups and it's crashes. So, we call this a crash. I mean, technically it's going to be labeled as a correction because it hit 20% and then responded so reflexively that we're back up here and we've rallied 20+%. So it's a correction. But, all I'm saying is, look, I want to pull back. I want to nibble at some pullback levels. I hope we get it. I would actually be more angry if this market gets to all-time highs. But I'm just saying, like, this market might surprise all of us where it just doesn't pull back. I hate saying that, knowing like I don't want to participate in that. I don't want to participate in this market making all-time highs and thinking like that's how I have to make money. So what I'll probably do is sell a bunch of covered calls and just keep collecting income, and I'll be fine. I can still outperform the benchmark making covered call trades. If I don't like a trade, I'm not going to force positions. Right? So anyway, if you said, I just funny, why am I so, I'm not political at all, man. If you know me, I'm a centrist. I'm a trader, but unfortunately, this crap is so in your face every single day. Like I said, we've never had a president that's tweeting about buying the market. We've never had a president that is saying, that's on the calendar every single week for a press conference or something that's going to be related to the markets, the bond markets, the trade wars affecting the markets, right? So unfortunately, it's now like blended into fundamental analysis. So anyway, and it's annoying. Look, it's exhausting. This look, 4 months, 5 months into this Trump 2.0 is exhausting. I mean, I didn't forget this stuff. 2016 to 2020 was exhausting because I don't want to be political, but you have to at least understand what's going on a little bit, be a little bit aware. I'm just saying that what just happened is we pivoted hard. Like Trump and company were willing to break something. Well, they got their taste of it, and if they wanted to make it worse, it could have been a lot worse. But I think the break here is it's forcing other countries to consider their alliances to the U.S. And I think that the reality is the markets need the U.S. I think the U.S. resiliency and stability and liquidity is going to have to be is going to have to stay steady. But the flows going to non-U.S. I think are going to be as strong as ever before. Like if there's 1 year that the dollar is going to show that, hey, look, the dollar's fragile, this whole idea of like moving away from the dollar, it is 2025. Because of what just happened these last couple months. This is the closest thing I've seen in over 10 plus years of how this whole narrative of this death of the dollar. Well, this might be the time. This might be the biggest crack in the dollar since I've seen, since like the great financial crisis. So it could force the world to align away from the U.S. and align away from the dollar and just, at arm's length, like, yeah, we'll do business with the dollar. We'll do business with the U.S. because we have to, but not because we want to. Like that might be how disruptive this whole thing's been. Okay. What says I can't. I mean, I guess it's a rant. It's not a rant. Like I'm not frustrated. I'm more annoyed of like what this market is. If this market gets all-time highs, I'm annoyed. But I say that and it's like, I'm at highs for the year. The nice thing is by the time we hit this level here, I was back above my portfolio highs for the year. And, that's well below the previous level. So, I mean, I'm still outperforming the markets pretty well. However, I'm doing it with more cash than I've had in years, like more cash to allocate, more money sitting on the sidelines. And I hate that. I want to invest. But I'm not just going to dump money into thinking like we're just going to, euphoria again. But it's kind of the probability of like, we probably will. We probably will go into euphoria. Why? Because sentiment, it's like the pendulum swing is so slow that we go from extreme fear to extreme greed. But what's funny is like greed tends to last a lot longer than extreme fear. And that's what I'm saying. Like that saying is so famous for a reason. And it's so true. This market might go up to levels that like nobody thought it could go up to, right? But in a given year, and this is what's so dumb about like basic Wall Street analysis. Every year the year starts, okay? The average plus or minus on the S&P is about 10%. Okay? So how does a forecast happen? Well, if we're coming into a bullish posture year, most Wall Street analysts are saying we're going to be up to about here by end of year. And they go, well, in respecting an anywhere between, if we average about 10% a year on the upside, the average drawdown is about 13% historically. So what do they look at? They look at those ranges. If we're up 10%, if we're down 13%, where are those levels from the beginning of the year? They map it out, and that's their forecast. And guess what? Forecasts are meaningless. They can change every single week, every single month, every single quarter. Nobody cares. They're all wrong. So what I'm trying to do is look at the charts. This in real time, we broke all the structure. We had that 200-day moving average. We had the rotation out of the Mag 7. Was this not forecasted and telegraphed? I mean, I said for multiple months going into the end of the year, I'm bearish going into early 2025. I think we're going to have at least a pullback, 10%. Well, we got it. Okay. You throw Trump on top of that, he accelerated this to the downside, you get 20%. Okay. Well, fortunately, that previous high in 2021, 2022 acted as support, and we have not looked back since. All I'm saying is, give me a pullback. So, and I'll just ask you, look, we always have a nice crowd here with A1 Trading. Would you be more excited about a chance to buy a dip? Or would you be more excited about, like, I'm just going to buy the highs? I mean, obviously, I'd rather buy a dip and have a chance to participate with another run to the highs, as opposed to, you got to get in, it's going to go higher. Because if you look at this, it's like, where'd you trade it? You either had the courage to trade it in the peak of fear, or maybe in here. And now you're trading in like this low volume, no man's land drift where it's like the market just doesn't want to go down right now. So anyway, all right, I'll stop the rants. I'm going to keep this chart blank. I'm going to keep this workspace blank. I'm trying to work with a cleaner chart, but does everybody see what I'm talking about here? I mean, if we have a pullback, that's a good support level. That's a good support level. If we find a way up to all-time highs and it pulls back, I mean, fine. Just I'm hoping for a pullback. I know. And we are close. We're close to the all-time highs on everything. So SPX close to the all-time highs within about 4%. Yep. NASDAQ from the all-time highs, because it did outpace on this recovery, NASDAQ is around 4%. Dow from the all-time highs a little bit further. Dow from the all-time highs is around about 6.5%. Russell from the all-time highs, way, way more to catch up. Russell from the all-time highs, about 17%. Does that make the Russell more attractive because it has more room to catch up? I mean, maybe, right? If this is a head and shoulders pattern on the Russell, maybe we get a chance to buy a dip here. Well, there's a good trade. That's a great trade in the Russell if the lows are in. And I do think that with rates cutting, I would hope that Russell can perform well because it gives companies a chance to be more profitable, have a runway for cash. But unfortunately, the Russell's not that profitable. 2,000 companies is not that profitable. Most of them don't make money, which is why I looked at the other ETFs. Like, this one is the top 1,000 value plays. This one is the top 200 growth. This one's the top 200 value. They are performing way better, and they're way closer to the all-time highs, right? This one is only off the highs by about 5%, 5.5%. This one's only off the highs by around 4%. Big freaking difference. That's how much more reflexive this is when you eliminate the crappy stocks in this index. That makes sense? So instead of having 2,000 stocks where you got a bunch of dogs and laggards, you have the cream of the crop that's like, yeah, top 200 value does well. Top 200 growth does well. There's growth in the Russell. It's just, it's the haves and the have-nots. So if you buy in the haves, the top 200, that's pretty good. Unfortunately, the option side of this isn't that awesome. So anyway, that's what's going on with, kind of U.S. markets. Non-U.S., I mean, VIX, we're down to some fresh lows again today on the VIX. Bond volatility is down. SPXY continues to kind of ramp up. Unless we have another vol event, I'm just going to, I bought the shares here like 35, let them go at 38. Short-term gain for me on SPXY. Dollar index, I still think the dollar index has room to pull back. Don't force shorts unless you get a trend line to break. Look, this whole thing, if this is a big swing from high to low, okay, I think the dollar in this area, and this area, I know it's not a perfect top, okay, but within this area, I would expect that this high is likely going to be resistant, right? So we have, any bearish pressure is going to come back in somewhere in this region and then hopefully start pushing back down to retest lows. That would be my dollar outlook. Like, I'm pretty bearish, at least with the overarching trend, that this move is going to have at least a retest of the low. So if it's a resistance level, resistance area, that it rolls over, gives us a price pattern that we can trade back down to the lows. If it breaks the lows, then you're moving stop losses and you're getting some surplus below the lows. Okay, that's the dollar. Oil, your guess is as good as mine. We broke a floor, but we held the floor. We have just key levels here, right? Key level support. I could see oil just staying in the middle. I think if oil goes higher, that's inflationary. Oil goes down, everyone's unhappy because you can't produce at the same margins. So it's probably just it's going to be a lot of supply and demand manipulation to keep it kind of right around the $60 barrel. And I think everyone can kind of be okay. No major conflicts, no major uproars, no major mutinies. But it's kind of boring. I mean, I'm not bullish or bearish on oil. I just kind of watch and get out the popcorn and see what happens on volatility. I am long natural gas. I'm trading this one out to 2017, so I'm trying to give it plenty of time. But it's also kind of crappy. It's like we had this huge push to the upside, and we might come all the way back down to the lows again. I have no idea. So it's just a trade. I hope I can turn the diagonal spread into profit. I'm selling calls aggressively to lower my debits. Gold. Gold. I've been waiting for a pullback for a while, and I was, sounded like an insane person, just like I don't want to buy gold, and it's going up, and I don't want to buy gold, and it's going up. Well, eventually it peaked out at 3,500, and I'm not saying that it's going to continue to fall, but perhaps it's just an orderly correction. High to low, lower high to lower low, maybe a lower high to lower low, maybe a lower high to lower low, right? This area is a great spot. This area is a great spot. This area is a great spot. Buying gold between 3,000 and 2,800 to me is a bargain. If it's offered, nibble, nibble, nibble. I like gold at those levels. I think that's a good correction level. Okay, it's on this chart, XAU. I have some levels here. So I basically just looking at my daily charts, watching my 200 moving average. I'd love to see the 100, 144, and 200 levels hit. This bar count has gone over 400 bars on a daily time frame, which is pretty excessive. That's literally the same measurements that I took and why I was bearish on the SPY, the Qs, all the indexes this year, because they all had overbought conditions. This is why I was bearish on Netflix and Meta and Palantir and Carvana. And like there were 20, 30 stocks that had the same type of setup where it's like, we'll see a correction. Mag 7 was another one. Mags was also overextended. Okay. All right. 31,900. I mean, it's not, but do I want to buy it at 3,100? I mean, I know we bounced there, but I'm like, look, this is my chart. 100, 144, 200 moving average. That's what I want to see tested. That's what I'm willing to say. Okay. I mean, and I said this yesterday, if you want to buy it here, that's fine. But you talked about dollar cost averaging this morning. If I buy it here, I have to be prepared to buy it here as well. Because if I was going to average into an area, this is fine, because then it's like, okay, I'm participating in gold. If it goes higher, great. Okay. If it doesn't go higher, well, I want to participate more and more and more, and probably make sure it doesn't really break this trend line. So I want to keep dollar cost averaging into this area. If this goes back up to retest highs, hooray, that's my trade. I'm happy. If I want to hold it for, upside forever, fine. But at least making a trade out of this, I need to get a dip or a pullback. Silver, still like silver a lot. 29 is good support. 26 is great support. I don't know if we're coming back to those levels. I would just be watching this right now, this little structure here. So if it just chops around a little bit longer, hopefully something helps push silver higher. If gold is going to continue to decline and correct, I think silver will do the same thing. So, if we see the structure, that's fine. But if this gets a little bit choppier and then goes further to the downside, I'm looking at 29. I'll probably start adding in silver futures trades if we get down to 29, because I can position for that for income. And then I'll probably add shares between 29 and 26 on SLV. Okay, Bitcoin 104. I mean, I'd like to see Bitcoin fall back to like 97. I'd like to see Bitcoin fall back into the 90s. Like I should say like 80, 88 roughly, to fill back some of these inefficiencies. But we're sitting here at all-time highs. Clearly, Bitcoin is getting some mainstream love. There is an impressive amount of resiliency and risk appetite has come back in the markets a big way. And so I think that greed is flowing back into Bitcoin. And, technically speaking, if we hit this level, I do think we have a probability that we pull back first to accumulate again before we have another run to all-time highs. Okay, but I'm not letting go of my positions. I mean, if we go to highs on Bitcoin, I'm not closing out my trade at 108. I want Bitcoin to run and get some momentum. Let's get to 120. Let's get to 130. Let's see some headline celebration on Bitcoin. But if we pull back, I'm just going to use it as an opportunity to, allocate and accumulate more. Okay. All right. That 62 is getting called away this week. MicroStrategy up to $400. As long as this one stays above 390 for me, I get like $1,100. I also have, I did the numbers here. So this one's out to the end of the June. I'm still going to roll this one. Honestly, it's like until we see a ton of correction, I'm just going to keep rolling MicroStrategy. So when we get towards the 627 expiration for me, we get towards the 627 expiration, 252.57 minus 310 on 300 shares. I mean, I've got $17,000 on MicroStrategy if I don't do anything right now and price stays above 310. Once we get close to expiration, I can roll my 310 out another week, out another week, out another week, and probably increase this to 18,000, 19,000 over a couple of weeks. Cool. I'll do that. I will use it as income. I'm not trying to chase MicroStrategy to the upside. My call is at 310. So if we stay above this, and let's say this is support and we bounce, I'm not going to chase this thing to the upside. I'm just going to stick with my little 310, keep rolling the covered call, get a little bit of income, and that's all I can do. Now I can participate in separate trades, but I was doing bull call spreads in here. Those are what I'm looking at. I paid $3.50 for something that could pay me $11.50. So I mean, I'm just using it as a high premium. It's highly volatile, but a high premium stock that hopefully can offer me some profit. Pullback levels, I mean, yeah, your pullbacks are fine. If pullbacks, I mean, we pull back here, there's some good structure to offer some support. If we pull back into this run, I mean, you can put a fib on that, right? This is your bigger swing. We go from low to high. There's your big swing. Okay, so take this swing, and where have we been dancing around? Interestingly enough, we've been dancing around this 70% level, right? I'm just going to say this. This swing from low to high and pulling back 70%, this over my years has yielded a wedge, right? So MicroStrategy might not be the ballistic all-time highs Bitcoin proxy that's 2 to 3 times leverage. It might not be that. If Bitcoin hits 108 and then pulls back to 75, MicroStrategy is probably pulling back to 250-ish, right? Which is okay. It's fine if you're using it for an income vehicle. It's going to be head spinning volatility if it's like it goes up, from 240 to 400, then back down to 250, then back up to 350. It's going to drive traders crazy trying to look for like all-time highs. I mean, maybe my wheelhouse this year is like I've got enough positions now that there's income generation in some of the shares that I own, and that's an easier trade for me than trying to guess where this market's going to go. But that's what I would say. I mean, this to me looks like it could be a potential wedge. All right, Coinbase. That didn't take long. We had a one-day drop from a hack, but because they're being added into the S&P, Coinbase is ripping to the upside. I did some 1-1-1 trades and ratio spreads, which were nice for income. I'm not chasing this at all. So, it's fine. I don't have any trades on Coinbase. Ethereum. I'm sure we got some Ethereum lovers out there. I'm not. I know this ripped very aggressively on the right-hand side of the trend line. A bull flag. I mean, if you're interested, a bull flag here could still get some legs and retest these highs, but you're going to want to see Bitcoin make all-time highs, I think, for Ethereum to catch up. If you started trade one here and you'd use this pocket on this big breakout candle as a second trade, as long as you don't invalidate that low, there's pretty good upside here. I think there's another like 30 to 40% to get to the highs. Yeah, 50, almost 60% to get to the highs. I mean, the trade looks good. I just don't necessarily love Ethereum more than Bitcoin. But I think it's a good trade. Copper, we'll see. These green lines are a little lottery play that I put in. I paid about $90 for something that can make me $1,400, but I need to see copper stay in between here. This trades out for about 40 days. So I'm just kind of calculating like maybe this structure is good enough to be so confusing and so choppy that even if it goes down, it kind of swings back up, and I can get lucky on a little lottery play. It's it's a low probability trade. I might win. It's like a maybe 11 to 15% chance I win the trade, but if I do win, it pays 14 to 1. Japanese yen, meh. If Japanese yen comes back down to here, yeah, I'm going to take some Japanese yen buys again. Nikkei, this is my EWJ exposure. What up, dude? EWJ, this is my way of playing the Nikkei. It drops the bottom 15% of stocks. I'm looking to see if this will revisit all-time highs. If the U.S. market gets to all-time highs, I think the Nikkei will follow suit and go with it. DAX, dancing around these all-time highs. I talked about this yesterday in one of my sessions. If we take this low, this high, any type of pullback in here, I would hope has the ability to retest. I think what would be really frustrating is if we go highs, lows, and this is a bear trap or a bull trap, and we come, back down to the halfway point or maybe further down. But that would be the whole U.S. market's going to have to turn south as well. I don't think that's the case. I think if anything, there is a window to consolidate, and then to see if this goes higher. If U.S. markets go higher, I think the non-U.S. markets go with it. DAX goes with it. FTSE goes with it. Right? I mean, FTSE's getting some love. All-time highs are right up here. So if you're long FTSE, probably to these highs, right? And then it consolidates, and then you look to see, can it break and go higher? There's your global asset bubble. Don't fight it, right? If we're going to all-time highs in the DAX and the FTSE and HSI and anything that's non-US, I mean, don't fight it. Argentina, all-time highs. Brazil, I think there's plenty of upside here. It's beat up emerging market play, but I like the potential. I like the asymmetry. Mags are at 52. We'll see what happens here. If Mags gets a pullback, I would say this: Mags pulls back in here, then the market's going to come back with it as well. There is some interesting resistance in here. All right, Daniel, take a look at that. Nice. Let's see here. Apple, fine. Amazon, fine. That earnings play, that was disappointed. It was literally a day after. This is a Friday close, and this is Monday. I was so stupid. Anyway, my shares at Amazon, I just have 225 calls, and my break-even price is like 120. So I'm just trying to sell covered calls on Amazon and keep collecting income. Ratio spreads, that's my exposure here. So Amazon ratio spreads. So sitting in some profit here, about 85% of that credit out 35 days, likely going to be a winner, but it looks good enough that are we going to get to 150 by June? 150 is oh boy, there's like a 2% chance that this level's threatened. So yeah, I'm going to hang on to that trade probably till expiration. That was just, down here when prices were down and IV was high, I was selling premium. So I'll look for that income on Amazon. That'll pay out pretty well. I mean, all in all, between this June expiration, that's about $2, $4, $6, $800, and then another $2, $4, $6, $8. Yeah, but about $1,600 on Amazon for income. Shares I own driving the prices lower. Broadcom, I'm not chasing this crap. I took a ratio spread down here, made some money. Google, I'm happy to see that we responded off this 150 low. I put some spreads out on Google. I think the 105 by 100 right now when the premium was really high. So I'm going to ride that out a little bit longer. Meta, turn. I'd like to see Meta come back a little bit. I really wanted Meta to get down to this level. I was hoping we get to like 450 or lower. I wanted to load up some ratio spreads on Meta. Didn't get the opportunity. I took like one stab here. I did some income trades in this yellow box and it worked out fine. Microsoft, just simple dollar cost allocations. I bought in around 400, 415, 400, 375, and it's up in profit. All-time highs are at 469. I would not be shocked to see a bit of a gap fill here at all. We're coming up to some resistance if this pulls back a little bit. So, I mean, one thing we can watch for the markets to turn, if the S&P is going to turn, watch for MAGs. If MAGs turns, then S&P probably goes with it. There's still big stocks that are heavily weighted in the markets. Netflix, another all-time high. Nvidia, had a nice little surge. We got the Nvidia's got a little partnership going on with the with Saudi Arabia, UAE, and looking like they're kind of using them as the big AI build out. So it's nice to see Nvidia kind of come back from the dead. A pullback. I'm sure now it's like buying dips for Nvidia, whereas before it was, under the 200 moving average, this thing looked like it was dead in the water. Everyone's hating on Nvidia. It's going to lose its competitive advantage. It doesn't actually make chips; it just designs them. So all the haters were, crazy bearish on Nvidia, but it's such a profitable company that I wouldn't be shocked to see it go to the highs again. But I'm not going to guess it's going to $200. Okay. If it dances around here and then pulls back again, it's like, I'm going to turn my ownership of Nvidia into an income trade. This July collar at 130, once I get close to expiration, I'm just going to roll calls, and participate as long as I can until I feel like it's not favorable to roll calls anymore. Tesla, we're trading at 347. I've got 277.50 covered calls. I have sacrificed, $50 to $60 of upside, $70 of upside, but I also survived all this crazy, high premium with some good ratio spreads, and I'm getting anywhere between like $200 to $300 a week in rolling calls, and I'm going to continue to do that. And if we stall for a little bit, then I can kind of play catch up on those covered calls. Berkshire, nothing there. I do want to check Spotify. I should probably add this into my mix. You piece of crap. I'm trying to see if Spotify will dip back. I need this to stay below 670. I need this to be less than 670 for this June expiration. It's a butterfly, prices up here. I have a profit trap, but I don't want to see this thing going to all-time highs. This high was around 664. My profit trap is 670, but that's right near expiration. So not ideal that this is up here. I'd like to see this kind of fade back down to like 620, 609, whatever. Stay a little bit off these resistance levels. Bond markets, down in the day, down in the day. I just think that the bond market's going to be just garbage. If we get a pullback in the S&P, then yes, pullback in the S&P might yield a little bit of upticks in TLT. I'm rolling my diagonal spreads down aggressively. So I bought a 65 and I'm selling an 89. And after that 89 expires at the end of the month, I'm rolling it again to an 89 or an 88. Like I'm just going to keep chipping it lower. I'm trying to I'll make a few bucks in this. I'll try to turn this for a couple of hours of income. Initially, the plan was when this thing was surging, I'm like, well, heck, maybe we're going to get this thing up to high 90s, and so I had a 96 call. Well, I rolled that down to 89. So I'm sacrificing some of the gains, but I'm trying to also keep the premiums high if I can. Gold, we talked about it. Gold is, I'm just looking for a pullback towards the moving averages. I like 3,000. I like 2,900, 2,800. I'd like to see some deeper levels pullback wise. Let's see here. That should be about it. Some of the Qs or the China stocks, Alibaba, not getting called away, which is fine. Baidu not getting called away, which is fine. I'll just keep selling calls on those. FXI, I still have some shares. I'm looking at all-time highs. KWeb, I don't have any shares left in this one. JD, I do have some shares. I'm just going to sell some more covered calls. Schwab Dividend, Schwab Growth, bought some shares of those. SCHY, bought some shares of those. Here's your market breadth. 72% of stocks now above the 50-day moving average. 72% of stocks above the 200 or the 50-day moving average. So, this is as far as short-term buy zone. And look, we timed this thing right here, right? When this thing was down to the lows that I've been watching, and we talked about it earlier, we were sitting here early in the year. I'm like, look, if market breadth comes down to these levels, we should be looking at this as a timing indicator to buy. When did that bottom? Well, that low was April 4th. There's April 7th. There's April 8th. We all know what happened on April 9th. Okay. You had an opportunity to get long. I got long on a synthetic long in the S&P, and that was a buy call, sell put at the same strike. And I got a lot of that rip plus debit spreads, plus, selling puts, plus 111s. Like it was a great time indicator. And I like the market breadth indicator for that exact reason. Now I will say the same thing here. I'm not going to be as aggressively short, but if we have this coming back up to these highs again, when like 91% of stocks are above the 50-day, I'm probably looking at that as a short-term opportunity to take profit, number one, and two, probably get a little bit of a pullback. Okay. Lowest call on gold. I mean, if gold comes back to like 2,800, I'm pretty happy with that. Okay, and this is the 200 moving average. Now we have about 52% of stocks above the 200-day moving average, which means we are getting that buy zone to print again for over half the stocks. I said this week, I mean, this was at like 48, 48, 48, which means that we still had a majority of stocks, slim majority, but majority of stocks are still below the 200-day moving average. But now they're above it. So we have, 70+% of stocks above the 50-day, 52% of stocks above the 200-day. Market breadth is looking a little bit healthier across the board. Sector performance is really interesting this year. If you go year to date, sector performance year to date. So consumer discretionary is still down, which makes sense. I mean, obviously we had some fear in March and April. So, those, if it's like you shouldn't buy it, don't need it, don't buy it. So discretionary down. Healthcare, UNH is probably the big catalyst for this. Look at the holdings. Johnson & Johnson, AbbVie, UNH was a much higher index weight, but because it's been beat up by 60%, it's been dumped. I mean, it's down 45% for the year. That's pretty nuts. But anyway, I mean, industrials, I mean, look, by the way, like financials, industrials, utilities leading the charge this year. This is typically not the bull market that you want to see. If you're aggressively bullish in the US market, you don't want to see industrials and utilities leading the charge. I mean, these are like options are garbage on utilities. They're just basically like high debt dividend stocks. That's what utilities are. Now they're performing well because they're getting deals done with, large cap tech. Like Google is partnering with energy companies. I think Constellation Energy and NEE for Newmont, or what's NEE? Is it NEE? Yeah, next era. So next era, Constellation Energy, they've been really big performers this year. But my point is, like, this is not your typical lead in a bull market. Are others playing catch up? Yeah, maybe. I mean, maybe tech catches up and swings the pendulum the other way because it's back in green territory now. But tech was down, 20+%. So anyway, obviously this year we've experienced a massive rotation. Massive rotation. SPY 595 is growing a little bit today. I don't think enough for me to. It's not going to force me to take a buy trade though. If we get to 595, cool. But I'm not going to trade on. I'm not trading this. What's the expected move today? 89. It'd be a $6 move. What's the expected move on the S&P right now? S&P for the day for the SPY. We got about another $1.76 left, and I'm looking at this thing having to go up like 380. I don't think we're going to get there. So it's tempting, but it's going against the grain of what the markets are probably pricing in right now with this type of volatility. So, yeah, I'm not going to take the bait for a 0 DT. All right. I don't realize I've been going for about an hour and 20 minutes, but I'm almost done. So market breadth is coming back. We'll see what happens. NASDAQ, same thing here. 82% of NASDAQ stocks above the 50-day moving average. It's also a pretty good timing indicator. Once we get here where it's like 90+%, it's been a pretty good topping pattern, at least for a pullback. Not saying it's bearish, just a pullback. Okay. Other stocks. I mean, Costco is still grinding higher. I've got a bunch of ratio spreads down here in the 600s. Walmart. What's crazy about Walmart is this is, a good barometer for the U.S. consumer. Even the wealthier demographics can still go shop at Walmart if they wanted to save some money. But it's also trading at 37 times earnings, which is very extreme. I think this is probably overvalued, along with a lot of other stocks. I think our PE ratios are pretty high. Not bubbly yet, but pretty close. I mean, we haven't seen valuations this high since 2000. Nike, hold my puts. I've got 55.50 and 47.50 puts. Home Depot and Lowe's are not low enough for me. Took some ratio spreads on the cards, MasterCard, Visa, Amex. Not in those anymore. Johnson & Johnson holding some puts. Progressive took some trades. CB is going to be for full profit today. Palantir, not chasing this thing. I just did a ratio spread. This one's already up like 60%, I think. Let me check. Palantir. It is up. So I pulled in 250 on a bunch of accounts. So I don't know. It's going to be roughly $3,000 or $4,000 on Palantir just by. I mean, this is only 34% max credit, so got a lot more to go. But these are all the way down to the 50s. So Palantir's got a long ways to drop if I'm going to have any type of threat to the trade. But you never know. I think Palantir's look as the best performing stock of 2024. The market's clearly given a lot of love this year. This thing's already made a swing of 100%. 100%. Ladies and gentlemen, you could double your account if you just put all your money in Palantir at the 200 moving average. Congratulations. You just crushed the market this year. Kind of, Dennis. Yep, Dennis asked, would you rather wait for them to go down to enter long? Of course, man. I mean, because look, I've been long at the bottoms. You know, I bought the SPY at 496. I bought the Qs. Where did I buy the Qs at? It was just off the lows. I bought the Qs at like 415. So 496 SPY, 415 Qs. It's like, why would I want to buy it here? I don't. You know. So I'm looking at this gap fill. I'm just like, come on, dude, something, anything, and maybe I don't get it, right? Maybe this pullback isn't going to happen. Maybe this pullback it's going to run higher, run hotter, make me mad, and then it hits the highs, right? And then it pulls back. And maybe it doesn't. Maybe it doesn't. Maybe it doesn't. You know, who remembers 2017? I do. 2017, every single month in the S&P was a higher high. 2017, you can look at the performance month to month in 2017, every month closed green. Yes, we had a disruptive 2025, but if we are about to see a very similar administration, which is fiscal spending plus a Fed that's going to, not rock the boat, okay, then maybe we see every month from May to December positive. Maybe. I don't think that's real because that's never happened in 90 years, but it did happen in 2017. But this market doesn't seem to care right now. So anyway, I'm being a little snarky because it is aggravating to be like so profitable down here and such a, having to play in the fear and have that fear pay you, which is fine. But then when it's up here in like euphoria territory, I'm like, now what? Now I've got to buy highs. I kind of hate that. I hate participating in those highs. So I'm like, just give me something like a test of this gap. It doesn't have to fill the entire gap. Just come back and try to acknowledge that this thing jumped up 3% in 1 minute on Monday at 3 a.m. That's what happened. This movement right here was a 3 a.m. candle on Monday morning. So I'm willing to say that is an inefficiency that usually doesn't happen and certainly doesn't go unnoticed. So I'm hoping we get a bit of a pullback after this cycle with today's expiration and Wednesday's VIX expiration, and then we get something. Like acknowledge a pullback. Let's get some efficiencies. Let's get some buying opportunities. Okay. All right. Okay. I'll let you go for today. I've been going at it here for a little bit. Should be good for the rest of the day. Yeah. Off we go. All right. Have a great Friday, everybody. Thanks for being with us this week. And we'll see you soon. Thanks. Bye.
Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. From all of us at A1 Trading, have a great day, and we'll see you next time.